This is a market with a lot of variance.
The market's trying to figure out who's winning, who's losing.
I wouldn't be surprised if we see a little bit of a pullback in the CapEx.
It's really a balance of both the spending and the returns.
The demand's there and it's outstripping the supply.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, facing down higher prices, the US and Iran engaging in strikes for a 10th consecutive day as the White House is gearing up to slap 50% tariffs on Canada. TSMC is reportedly planning to raise chip prices by up to 10% to reflect rising costs.
And when it comes to the oil market, we are seeing these elevated prices. Brent just shy of $90 a barrel. And guess what? Right now, with the 10th day of strikes, there is no off-ramp just yet that the United States is willing to take. And Axios talks about this, the two options, the fork in the road for this administration. Either take potentially that 10-day ceasefire that mediators are putting out there, or, this is according to Axios, option 2, launch a massive joint military campaign with Israel to force Tehran's capitulation. Will it work is the question, as both of these forces, Tehran and Washington, fight over the control of the Strait of Hormuz.
Just sit on the price of crude. What do you do with that this morning? $90 a barrel on Brent crude, facing down substantial multi-way risk. Either we maintain this messy status quo, or it goes one way, or aggressively the other.
And not only maintain this messy status quo, but it potentially can get even worse for the oil market if the Houthis come through on their threats and block the Red Sea and the Bab el-Mandeb Strait and really take off a lot of Saudi product that's currently on the market, which is why you have the likes of Goldman Sachs saying into the fourth quarter, if this continues, we could see Brent higher than $120 a barrel.
Francisco Blanch of Bank of America coming up a little bit later in the program. Stay tuned for that. The cushion this time around is a whole lot smaller. Inventories have been drawn down globally, aggressively. The SPR in this country, the lowest since what, the 1980s? Yeah. And the situation in product is even worse. And if you speak to these guys right now, they'll say, forget crude. Look at crude product. That's where the problems might be.
That's what Jeff Curry was saying. He was like, you're focused on the noise basically coming out of the screen. You have to look what's going on in product. And we saw that yesterday. And that's a real pressure point for this administration. We're in the middle of peak driving season, summer holidays, and already you have a gallon of gasoline above $4 a gallon. And you know what, Jonathan, and we've talked about it a lot on this program, there are going to be potentially really good politics the president can come out and say, but potentially really bad policy for the oil market.
That's the situation with energy. Let's talk about the situation with Canada. Seen the president sitting alongside the Canadian Prime Minister for the World Cup final Sunday. 24 hours later, the White House is gearing up to slap Canadian product with 50% tariffs.
So I think it's important to understand that at the moment the market is kind of shrugging this off because we have been here before, and I think there's an understanding that this president does like to negotiate with tariffs as a threat, and we're in the middle of USMCA negotiations. And then you look at what the items are subject to when it comes to this tariff. Milk, hockey equipment, beer, and plywood. Major resource imports, energy, potash, critical minerals, those are not part of this, which basically says to me that the United States wants to make sure that they are protecting the most important parts of trade that can hurt their own economies. Also, once this is signed, it doesn't take effect for 30 days. So I would say this is the start of a 30-day negotiation between President Trump and Prime Minister Mark Carney.
Market investors worldwide sitting here looking at these two risks and saying, I've seen this movie before. I've seen this movie in the Middle East. I've seen this movie when it comes to trade. And we're becoming very, very familiar increasingly with a very uncomfortable new normal.
Yeah, this is the new normal. There is going to be tariff headlines, as we've been saying since Donald J. Trump walked into the White House for Trump 2.0 and his second round of this. There are going to be tariff headlines throughout his entire presidency because that is how he likes to negotiate. When it comes to the conflict, that's a little bit harder to game out. How long are we going to be living in this new status quo where the president does not want to fully commit just yet to another outright war with Iran, even though it feels like that? But he certainly is. This is certainly not a ceasefire. It's this new purgatory.
Markets are not blinking. Check it out. Equity futures this morning up by 0.5 on the S&P 500. A bounce following a three-day slide on the S&P. Coming up this hour, we'll catch up with Julian and Emanuel of Evercore as stocks look to snap that three-day slide. Francisco Blanch of Bank of America warning crude could exceed $100 a barrel. And Jane Foley of Rabobank as the UK ushers in potentially a new fiscal era. We begin this hour with stocks rising as investors await another round of earnings. Julian Emanuel of Evercore writing, the brave new world of higher tech stock volatility does not mean the bull market is ending. Expect positive price reaction from large cap tech earnings to catalyse the next leg higher. Julian joins us now for more. Julian, good morning. Good to see you.
Good morning.
That is confident. It's almost bold given the reaction we've seen to some of the tech earnings so far.
Well, look, so first thing is that earnings reactions have been all over the place in general. And that's actually typical for an environment where stock correlations are as low as they are. But coming into this season, we just felt that there was this cohort of large cap tech stocks, short interest extremely high, earnings are going to be fantastic, sentiment really terrible. And frankly, what we're going to probably find out at the end of this earnings season is that the free cash flow amongst the hyperscalers will cross that zero line. But the market's discounted that already. And so from our point of view, the unloved has upside.
So you're expecting positive reactions to Google, to NVIDIA. Let's start with Alphabet. Alphabet reports later this week, tomorrow, I believe. If they come out and raise CapEx intentions, how does the market respond to that?
So that has been one of the key questions. We think that the market, again, because these large numbers, we're looking for $1.1 trillion next year, have been discounted. But the market wants to see the confidence in the CapEx because if nothing else, you're going to stabilize the chip trade, which has, certainly had the mid-cycle crash.
It stumbled, so let's talk about it. You're at 77.50 year-end on the S&P 500, right? Mm-hmm. What's the path to 77.50 if the chip sector doesn't come along for the ride?
Well, again, it speaks to the weighting in the S&P 500. You could have large cap tech and value. I mean, very quietly, value stocks have outperformed significantly this year. Those could be enough, but we do think, you do need the chip sector to come along. The good news is that the tail that is wagging the global asset market dog, Korea, buyers emerged last night.
Right.
That's different.
As Jonathan mentioned at the top of the show, what's going on with TSMC, raising prices for some of their chips, according to this report. Do you think we're going to see demand destruction?
At some point, but it feels like that's still a way off. My colleague Krishna Guha talks about the waves of inflation and that, in fact, AI-related inflation in the near term has been more intense than expected, but you really haven't seen the demand destruction yet. And frankly, the market has been very efficient in terms of allocating capital and assessing risk around this. The narrative in our mind, again, thinking about earnings season, remains intact.
Do you think the market becomes more efficient and starts looking to cheaper models produced out of China?
Well, we've certainly saw that was the fright at the end of last week. It's trite to say, but frankly, you go back to DeepSeek, you go back to every one of these moments, and what we find, and it may not continue infinitely, but we certainly see runway based on past chip cycles in particular, that this goes into 27, perhaps into 28, is that Jevons paradox continues to work. It just does.
Well, perfect timing. Here's the headline. It comes from the team over at Reuters. There will be a meeting between the President of the United States and the Chinese leader in September. I'm sure you're aware of that. What will they be discussing? According to Reuters, the US and China plan to discuss AI ahead of that visit.
That's what I thought yesterday was going to be the number one topic for this president to bring up after you had the Kimi K3 model released by China, and you also had Xi Jinping, when that model came out, was speaking at an AI conference and has 30 other countries signing up for the way China views the world in AI, except not the United States. So you really see a bifurcation of these two separate economies and also how they are developing, potentially regulating AI.
It's a different moment, Julian. The risk to this rally in America, the source of that risk might be outside of the United States. It might be in South Korea. It might be in China. How do you frame those risks this morning?
Well, no question about it. And look, what we have seen day in and day out is a much higher baseline level of volatility for technology stocks than the rest of the market. And our message is get used to it. We are long enough into the cycle, and there are enough risks, headline risks every moment, conceptually, that you're going to have higher levels of volatility. But again, and this was only a month or so ago, remember that volatility, when you think about the memory stocks, works to the upside as well as the downside.
Got some leverage building in South Korea that maybe we need to work out at some point as well. Julian Emanuel of Evercore is going to be sticking with us. Check out equities this morning, positive by 0.5% on the S&P 500. If we turn briefly to the bond market, you'll notice at the front end of the curve, twos are just about unchanged at 420. Yesterday, the first close above 420 on a two-year yield since we had that softer than expected CPI reading a week ago. We can't get away from that number. This rate hike debate is still alive and well, encouraged by the Fed hawks. I'm thinking of the Cleveland Fed President, Beth Hammack, and encouraged by this move in crude as well, just lingering around 90 this morning.
Yeah, Beth Hammack saying for the first time in her tenure, businesses, consumers are clamoring about higher inflation. They're saying you need to do something. And then you wake up in a morning like this and Jonathan, the top three headlines you read all talked about a higher inflationary environment, whether or not it's tariffs, Brent crude, given the conflict persists in the Middle East, or TSMC with this report out of Japan that they're going to have to start raising prices for their chips.
Brent crude around 90 this morning, up a third of 1%. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. U.S. forces striking targets in Iran for a 10th straight day. The attacks coming after Tehran-backed Houthi militants in Yemen threatened to blockade Saudi Arabia in the Red Sea. The UK Navy saying a tanker was struck in the Strait of Hormuz. British Prime Minister Andy Burnham naming former Defence Secretary John Healey as the new Chancellor of the Exchequer. His appointment was unexpected and come weeks after he resigned in a fight with the Treasury over funding. TSMC is raising chip-making prices. Nikkei reporting the company will raise prices for advanced and mature chip production services by up to 10% to reflect rising costs. The higher prices are set to take effect next year. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time. Just a quick update from AP confirming, according to them, that an Iranian official has begun meeting with mediators in Pakistan this Tuesday. So that's part of the multidimensional risk that this market is facing this morning. It can go one way or the other.
And the same way the United States puts out carrot and sticks and signals, Iran is doing that as well. On one hand, they are meeting with mediators. Maybe they will take that 10-day ceasefire off-ramp that's being offered to them by the Pakistanis or the Qataris. At the same time, they have the Houthis putting out their own threats. There's carrot and stick, a lot of signals here. Someone has to blink potentially.
Negotiating in real time here in public through financial markets. We're down on Brent now by about a tenth of 1%, still around 89. Up next on the program, maintaining the tariff wall.
I really think we're helped a lot by the tariff situation that's going on. I used these tariffs, took in hundreds of billions of dollars to make great deals for our country. I hate to pay people back tariffs. We have other ways of tariffing. As you know, we're already doing it.
Just imagine you had a great date. You went to the World Cup final of all things. You wake up in the morning, they haven't texted, and they just slap you with tariffs instead.
I wonder if they spoke about tariffs while there, because you made a very good point when I walked into the studio this morning. Howard Lutnick was there,
Lutnick
his
was there
Commerce
too, yeah,
Secretary.
in the box.
So potentially some of this was discussed, I'm not sure.
We'll pick up on that story in just a moment. Up next, we'll catch up with Bloomberg's Tyler Kendall, live from New York City this morning. Good morning. "15 minutes away, we get some earnings for you. General Motors at about 6:30 Eastern Time. Look out for those numbers to drop later this morning. We'll catch up with the CFO, Paul Jacobson, later on this morning. Paul Jacobson joining us at about 8 a.m. Eastern Time. After that, earnings really pick up later this week. Tomorrow, we'll hear from Alphabet. The following week, you'll hear from Microsoft, Meta, and all the big boys in big tech. Let's start with the equity market this morning. The scores look like this. Equity futures shaping up as follows. Futures positive by 0.5 on the Nasdaq, up by 1.36. It's a bounce back. Semis picked up yesterday. Bit of follow through again this morning. Some outperformance there on the Russell. We're still positive by 0.75%. It's a better tape this morning for the equity market bulls. Turn to the bond market story. 2s, 10s and 30s. 2s still around 420. Yields come in a basis point off the back of news just a moment ago that brought crude a little bit lower as well. Check out Brent and WTI. Brent at the moment is still positive by about 1/3% at about $89 a barrel. Some news crossing from AP just moments ago.
A positive development when it comes to potentially an off-ramp that Tehran and Washington could take, with AP saying that an Iranian official has begun meeting with mediators in Pakistan. We do know as of yesterday, there was this report that mediators have been trying to at least offer a 10-day ceasefire for both of these countries to stop the back and forth strikes we see for 10th straight day. If they take that off ramp, that is definitely going to be negative for the oil market.
Two proposals here, AMH. You've got a ceasefire proposal. That's kind of the bearish story for crude. Then you've got the bullish story, the threat from the Houthis threatening to shut off the Red Sea to Saudi shipping. And Bramo was on the programme yesterday. Good morning, Bramo, if you're awake this morning. Lisa made the point, and it was a good point, that this market seems to be weighting one alternative versus the other just a little bit more, given the experience of the past few months.
Right, because I think the experience of the past few months is that you see that both sides want to find a diplomatic off-ramp. But of course, the issue is neither side wants to concede control of the Strait of Hormuz. The United States, Gulf Arab partners, want it to be an international waterway, as it has been for decades. And the Iranians have now used it as a point of leverage and realize and have been successful at making money off of it, because there have been vessels that clearly have, dialed 1-800 Hong Kong Bank and paid the fee in Bitcoin. They've realized they could be successful at it, and they have been. So that's where the tug of war is right now when it comes to this conflict. We haven't even gotten to the nuclear portfolio. That is going to take, when JCPOA took 20 months, that is going to take months and years.
This is the messy status quo, and just for the record, I feel bad now. Bramo has not slept in. She has never slept in. This was a scheduled day off.
Yes.
Lisa's
and I bet
back
she's
tomorrow.
watching. Good morning.
She's back tomorrow. Good morning, Bramo. Under surveillance this morning, maintaining the tariff wall.
I am a tariff man.
To me, the most beautiful word in the dictionary is tariff.
I really think we're helped a lot by the tariff situation that's going on. I use these tariffs, took in hundreds of billions of dollars to make great deals for our country. I hate to pay people back tariffs. We have other ways of tariffing. As you know, we're already doing it.
So here's the latest this morning. The president vowing to impose a new 50% tariff on some Canadian goods. The president citing Canada's unfair treatment of American alcohol, cars and dairy and hockey equipment as well. Bloomberg's Tyler Kendall has more. Hey, Tyler.
Hey, John. Good morning. Well, this 50% tariff would mark what is considered to be the most severe trade action President Trump has taken against Canada if enacted. The tariffs will go into effect after 30 days and are expected to impact about $20 billion worth of goods, which shakes out to roughly 5% of Canadian exports to the U.S. Now, you went through some of the list of the items there. Importantly, these items will not be able to claim exemptions under the USMCA. The White House is using this obscure trade law. They've never used it before, alleging that Canada has been discriminating against U.S. commerce. We got a list of examples, including how some Canadian provinces have banned U.S. liquor products. It marks what is considered to be an escalation in what's been a relatively tense relationship between President Trump and Canadian Prime Minister Mark Carney so far this year. Just last week, President Trump threatening tariffs over the wildfire smoke. Earlier this month, the U.S. declining to renew the USMCA, setting up potentially years of contentious negotiations. Though we should say our own analysts at Bloomberg Economics say that they think that either part or all of these tariffs will end up being delayed or canceled, as they view this as a negotiating tactic by President Trump. And John, to that point, we got a statement from the Canadian Prime Minister Mark Carney overnight saying that the country is ready to, quote, engage intensively with the U.S. to address any issues.
Tariffs on smoke I can get on board with. Tyler, thank you. Tyler Kendall down in Washington. I'm sure most people in the Northeast can get on board with that, can't they?
It's been terrible, the air quality, so maybe Canada could help with that. But administration official had said that this is not in response to the air quality and smoke in terms of what's coming on from the Canadian air. This is just tariffs that for different reasons.
There is always a signature tariff, and it always gets to the heart of national pride of whatever country is talking about. Germany, it's autos. France, it's always champagne and wine. Right? It's always champagne and wine. And Canada, if you want to get after Carney, go after hockey.
So when I was reading the list of items, I was like, okay, some of this I could see makes sense. Milk, beer, plywood, things that come from Canada, small but won't totally hurt the U.S. economy. And then I saw hockey equipment, and I said, this is the biggest troll.
The ultimate troll.
For the United States right now on Canada, especially since America's incredible win at the Olympics.
Julian Emanuel of Evercore joins us now for more. Julian, is that what it's about?
Look, everything is a negotiation. We know that. We're comfortable with it.
You're comfortable with it, and I find that interesting.
Well, look, it's a fact of financial markets.
We're like desensitized to these policy proposals.
We are. And look, that narrative may change after the midterms, but again, and every time we talk about the midterms, we realize the time between now and the midterms is like an eternity. So you just can't focus on it. And long run, we have a very favorite chart showing earnings progression over the last 30 years with the S&P 500. And there's lots and lots of noise. And we certainly had noise in the markets in the correction in March because of the war, and the previous year because of the tariff tantrum. But long run, markets respond to earnings.
When does the trade tariff story regarding Canada, also Mexico, given the fact that they are having these discussions about USMCA, when does it shift from noise to actually something you need to care about?
I'm not sure that it actually does, to be perfectly frank. And again, this is a lot about creating the narrative, and reinforcing the various other pieces of policy. And at the end of the day, the fact is that the U.S. economy continues to chug along, and that's what people are focused on.
It's conditioning as well. So let's start with conditioning. We saw this with China, markets up and to the right. Right? Got through. We saw it with tariffs last year, markets up and to the right. Saw it with the Middle East earlier this year, markets up and to the right. Now we're insulated by this massive AI spend. Is that what's insulating us all now, both the market and the economy? Just the CapEx from a handful of companies driving earnings for a handful of companies that on net is benefiting the market and the economy alike?
To an unprecedented degree. Look, if we think about the concentration in the S&P 500, 40% of the index, 10 names, virtually entirely AI. If you think about the rest, emerging markets are no longer emerging markets. They're an AI trade because of the dominance of Korea. If you think about the bond market, the problem here is that because of the AI-driven inflation, even if we get a sell-off in the memory names further, bond yields may not fall as they typically do. So what it comes down to is that investors are looking for alternatives to AI, and there are some, but they are few.
Abby Yoder, JP Morgan, on the program later. She gets asked this question all the time. Is it just one trade? She says it's not. Do you feel like this market has become just one trade?
Well, again, to a large extent it is, but what we've found actually in our work, that this is a very rare time, that there is a larger than ever group of stocks within the S&P 500 that are moving inversely to the index.
You call them the negative beta stocks.
The negative beta stocks. They are value, and lo and behold, value has done very well this year. But interestingly, it's not just value, it's not just negative beta, but it's very diversified. Makes sense that energy is moving that way. We know that. But it's also staples, it's utilities, it's healthcare. And for some reason that our fundamental analysts are scratching their heads about, it's insurance stocks as well.
Insurance too?
Yep.
Can they make sense of that?
It's not easy, other than to go back and sort of, zoom out and understand that the correlation among stocks is as low as it's ever been, at the same time that people are looking for alternatives, and at the same time that algorithmic trading tends to become a bigger and bigger portion of the market as days go by.
Julian, what a ride. Good to see you. Thank you, buddy. Julian Emanuel there of Evercore. Equities near session highs at 0.5% on the S&P. Up next, we'll catch up with Francisco Blanch of Bank of America, warning crude could top $100 a barrel once again. Plus your higher. How's your morning movers? Taiwan Semi rising on a report. Prices are going up for chip makers. That stock up by 4%. Equity futures this morning, this session highs. Here's the bounce, up by 0.5 following a 3-day slide on the S&P 500. Struggling to bounce yesterday, even with the chip sector leading the effort, looking to bounce back from a loss last week of 10% last week, the biggest weekly decline we've seen for the chip sector going back to April 2025. That's the equity story this morning. A better tape in the bond market, 2s, 10s and 30s. I mentioned this earlier, notable. 2s yesterday closed back above 420 for the first time since we had a softer than expected CPI report a week ago. That is largely because of what's happening elsewhere, including in the Middle East with the energy situation, but also the hawks on the Fed are determined to keep this rate hike debate alive and well. A week away, that meeting for the Federal Reserve next Wednesday. The 2-day meeting starts the next Tuesday. That's the bond market. Let's turn to crude. WTI and Brent looks like this. I mentioned what's happening in the Middle East. Brent crude around 90, 89.58. WTI around 83. We're up by about 0.4% on crude this morning. Bouncing back with the tensions lingering across the Middle East.
Tensions are lingering. 10 days of strikes. Once again, the United States going after drone and missile facilities. They say that they're trying to degrade Iran's capability for going after the commercial vessels that are trying to transit through the Strait of Hormuz. Basically, Jonathan, we're seeing a grinding halt when it comes to traffic through the Strait of Hormuz, making potentially problems much worse. Not the fact that Iran is going after U.S. allies in the region, but now the Houthis are threatening to get involved. And if they cut off Red Sea access, you're talking about millions of barrels of oil and product that potentially Saudi Arabia has been able to ship out, unable to do so.
Crude around 90. Numbers from GM just dropping. I'll get to them in just a moment as we count you down to the opening bell. Let's get you some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We are seeing TSMC ADRs catching a bid this morning, up 3.7% on a report in the Nikkei that the company is talking to customers about potentially raising its chip-making prices by as much as 10% next year. The company said it's dealing with higher manufacturing costs, but investors taking this as a signal that demand remains strong, because if TSMC is able to raise prices, that means that customers are willing to pay up for its chips. It also, of course, helps protect its margins. And that is helping to reinforce the rebound in the chip and memory sector, with names like SanDisk and Micron all rallying in the pre-market. The semiconductor index snapping a 3-day losing streak yesterday, and the recovery continues today. And what I'm hearing is that the recent pullback has made valuations look more attractive, and that is helping set a more positive tone as we get ready for our first batch of tech earnings, with both Tesla and Alphabet reporting tomorrow. Tesla up 1.25%. Investors will be looking to see whether its robo-taxi ambitions remain on track, and for Alphabet, whether that AI spending is translating into growth. John?
Yahira, thank you. Thank you for the update. Let's get to those GM numbers. EPS, second quarter, beat 357, the estimate 319. It's a beat and a raise. The outlook looks like this now. They now see full year adjusted EPS in a range of 12 to 14. They had seen it in a range of 11.50 to 13.50. So it's a better outlook this morning for General Motors. That stock is up in the pre-market by 3%.
Yeah, raising its full year profit forecast by another $500 million after beat the second quarter earnings estimates. This is really positive. Brighter outlook for GM. Large pickup trucks, FUVs making up most of their earnings. We know that the prices there have been quite high, but this seems to be that there's a lot of demand and they're able to save money when it comes to other issues. I'm really interested to see what GM has to say on the earnings call, because remember last quarter they were talking about how they are one of these companies that are getting rebates when it comes to the tariffs. Is that story still continuing?
They got some pricing power for the premium trucks. We'll talk about that later this morning. 8 a.m. Eastern Time. We'll catch up with the CFO, Paul Jacobson. Looking forward to that conversation later on. On our radar this morning, the United States and Iran trading military strikes for a 10th consecutive day. The Associated Press reporting an Iranian official is meeting with mediators in Pakistan. Reuters reporting a 10-day ceasefire has been suggested. Elsewhere, the Trump administration vowing a fresh 50% tariff on some Canadian goods. Milk, hockey equipment, alcohol and plywood are among the items targeted. Energy products and critical minerals are exempt from the new levy set to take effect in 30 days. And finally, TSMC preparing to raise prices for advanced and mature chip-making products. Nikkei reporting costs will rise by up to 10% starting next year. Taiwan Semi is the main chip maker for NVIDIA and for Apple as well.
So now over to all these hyperscalers. Are you going to have to spend a lot more? Are we going to see even more increased capital spending? Because TSMC, which is a massive chip provider to all of these companies, is now saying, well, actually, we're going to have to raise prices. Now, this is is according to a Nikkei report, but apparently, according to this report, they held these conversations with customers last month and prepared to make that increase as of next year.
Well, speaking of pricing power, and we talked about this now for much of the last 30 minutes, it's this story, it's a story out of Iran. You were talking about this, it's the story out of Canada. Who knows where that's going to go? But ultimately, the backdrop remains the same. It's the threat, the pressure towards higher prices in the year to come.
Yep, it looks like it's going to be higher for longer when it comes to inflationary pressures right now. AI story, conflict when it comes to raw materials, and then, of course, tariffs on or off, whether or not even the premium potentially means companies have to start thinking differently. And this is what Governor Beth Hammack was talking about, a Cleveland Fed president. This is what she was talking about. Businesses, consumers are going to her and saying you have to do something about inflation, which is why the next week, off of these headlines, would you want to be Fed Chair Kevin Warsh? Not sure. This one's going to be hard.
That meeting a week away. Let's talk about inflation and the price of crude. Crude rising this morning as Yemen's Houthi rebels add to uncertainty across the Middle East. The group issuing a warning for vessels planning to use Saudi Arabian ports. Francisco Blanch of Bank of America writing the following. If tensions do not abate for weeks, Brent could retest again above $100 a barrel. Francisco joins us now for more. Francisco, good morning.
Good morning.
And first of all, congratulations. You're in the stadium Sunday evening. Share with us what that was like to watch your Spain win another World Cup.
It was an absolutely amazing feeling, you know. It was also such a tough game, you know, where there was a lot of biting and kicking, if I may say.
Did you feel outnumbered in that stadium? Because
Definitely
it looked like
outnumbered.
Overwhelmingly there was Argentinian support topping Spanish support in that room.
Absolutely. I think it was 5-1, 6-1.
Crazy.
But you know, it was just one of those games that it's just history in the making, right? I mean, second star for Spain. That's doesn't get bigger than that.
Well,
right?
congrats to you and your country. Let's pretend you weren't here for that and you're here for this. All right?
Yeah.
Let's talk about crude. Cushions matter. Clearly, we had a big cushion going into the initial war at the start of March, the end of February. How big is that cushion now to support this market?
It's a thinning cushion, John, and I'm increasingly worried that these tensions could eventually turn what's been a relatively orderly market, where prices have moved in a linear fashion, more or less, and we end up being pushed into a non-linear event, meaning that rather than just steady movements, we start to see spiky behavior. And in fact, I think crude oil doesn't really tell the full story. The full story is being told by diesel, is being told by gasoline prices. I mean, you see crude oil at 90, but look at diesel, it's trading $150+ a barrel, gasoline approaching $150 a barrel. We have a true petroleum product shortfall here. And even natural gas, not in the US, but globally, starting to trend higher again, with prices hitting 60 euros a megawatt hour. So that's where the price pressures, where the pain points are.
Can we go through the potential risks in the future? The first one being the Red Sea. How much product could we see be taken off the market if the Houthis were to get involved and make it quite difficult for ships to go through the Bab el-Mandeb Strait?
Well, so it'll be another choke point. I think for product is maybe not as big. I think Bab el-Mandeb is a lot bigger for crude oil. And of course, for Saudi Arabia, which has been moving oil from east to west and has been one of the big relief valves for this Hormuz shutdown, has been rerouting through the other end of the Arabian Peninsula. But I think the issue with products is that we have Ukraine hammering Russian refineries, and we have up to a third of Russian refining capacity being hit or being damaged by Ukrainian military activity. On top of that, we have obviously a lot of oil, petroleum products that go through the Strait of Hormuz. And then just to top that up, you have a lot of countries in Asia, starting with China, the world's largest refinery toolkit, with the U.S. hoarding petroleum products and not being active in the export market in order to protect their domestic economy. So we have some of the biggest players in the world just either hoarding back or being damaged by military action. So effectively, the U.S. remains the place where you can come and buy your diesel and gasoline if you don't have any. So that's the irony of this.
Hasn't China, though, sort of put a lid on all of this by softening their imports?
They have, but they have softened their crude oil imports, not their gasoline or diesel exports, right? Remember, that's what China does. They import crude oil, and at the margin, they export some petroleum products. But yes, I mean, they've eased the pressure on the crude market. And they may have to come back depending on the duration of this conflict, because right now they're just drawing down inventory. That's what we're doing. We're drawing down inventories until we get to rock bottom.
So there's a phrase that I've heard a lot. I heard it from you, crack spreads. Right. Can you just explain to our audience outside of your world that might not be familiar with that, what it means and how big they are right now?
Yeah, so crack spreads are the differential between the refined product, diesel, gasoline, and the actual crude input that goes into making it. And right now we are record seasonal levels for a lot of products, like particularly gasoline and diesel. And refining margins are also exploding collectively because you have gasoline and diesel just running up together. Again, reflecting that scarcity of refining capabilities. So it's a major concern because if we have to ration demand, those products need to get to very, very high levels where they actually pinch your pocket. So even if crude oil at $80, $90 a barrel is manageable, it may have to be the petroleum product price that forces demand lower if we can't supply it.
Just quickly, if politicians start to see those spreads and they start to suggest that something else is happening here, something opportunistic, what would you say back to that? Purely from a market perspective, what is actually going on and why are they wrong?
Well, so I mean, I think the issue is obviously who's making the most money right now. You see U.S. refiners are effectively given a license to print money, and that's what's happening, right? They're getting relatively cheap input costs, and they are pushing enormous amounts of highly valuable product out into the U.S. and into the world. So there is that's one part of the market that is really benefiting from this situation. I think the broader concern is that prices. Because consumers don't consume crude oil. Airlines fly on jet fuel and trucks run on diesel, right? So if you're a transportation company, you can get hurt pretty badly. I think the view maybe in the U.S. is because America is such a large energy exporter these days, the U.S. is effectively the world's biggest petrostate, right? It's 20% plus of the world's production and a third of the world's gas. So I think there's the perception that the U.S. won't be as negatively impacted by all these tensions globally. But there will be other countries that will be hit hard, that won't be able to afford eventually these prices.
I remember TK used to call it Saudi America 10 years ago when the shale production, 15 years ago when the shale production boom really picked up. What's the client call like at the moment? I'm intrigued by that because I can tell you the reception we get every time we cover this story at the moment. Overwhelmingly, I'd say 80% of the audience right now kind of pushing back, don't need to worry about this, don't care. You talked about this all the time back in March and April. Didn't matter then. Why does it matter now?
Well, so I think back then inventories were very high. We've been drawing those inventories. And I think if you look at U.S. gasoline inventories, U.S. diesel inventories, U.S. crude oil inventories at Cushing, the Strategic Petroleum Reserve, they're all stocking out, right? So commodities move in a nonlinear fashion when you run out of stocks. And again, we haven't run out yet. I mean, we probably have another 2 to 3 months on crude oil, which is why Brent is not going crazy yet. But we are really running very close to tank bottoms for the petroleum products. I think maybe China comes to save the day. You've seen more aluminum exports from China as prices picked up. But it's unclear to me that China's have the appetite to essentially start using their system to release a lot of petroleum products into the Asian region. And we do need those products to run the economy.
What would be the impact if the United States bans exports?
Well, so that's, first of all, the U.S. would have a glut, right? Because the U.S. is such a large exporter. The U.S. is the biggest exporter of petroleum products in the world. It's around 7 million barrels a day of crude and liquids, petroleum products and liquids. So I think you have a domestic glut. I don't really think it'd be a very practical thing to do because you would just not create a major market dislocation. But there's a lot of things that can be done to try to pressure down domestic prices, which frankly are starting to go up again, right? So you talked about price pressures. I mean, I get this question all the time. Why are price pressures not abating? Well, in my mind, we run a very, very lax fiscal policy, which wants to be laxer because there's more potential for military spending, right, down the road. And then at the same time, and Kevin Walsh has said this, interest rates may just be too low for the level of inflation that we have. I mean, we do have real rates pretty much flat to negative, not just in the U.S., in a lot of places, right? So we may have too lax a monetary policy, we definitely have too lax a fiscal policy. So it's really hard for prices to normalize in that context, and that includes commodities. But also, it's difficult to rein in demand because, again, as long as money keeps on gushing, oil does too.
Francisco, it's good to see you. Enjoy your win, sir, for the next 4 years and maybe beyond.
I'm going to love it the next 4 years.
It's a very happy Francisco Blanch there of Bank of America, fresh off the big win for Spain over the weekend. Let's look at crude this morning. Crude, Brent around 90, still up by 0.5%. You heard it there from Francisco. We've heard it from Jeff Curry as well. You don't consume crude, you consume crude product, and crude product is where the concerns are right now.
Right, and you see that across the United States with gasoline above $4 a gallon. You see what's going on in Russia with the diesel export ban because Ukraine has been hitting some of these refineries more deep into Russian territory. And then on top of that, while we will talk about the fact that China has been softer when it comes to imports of actual crude oil, they've been hoarding when it comes to product. And that is right now where the pressure points are.
Crude around 90, up 0.5%. Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. General Motors shares trading lower in the pre-market. The company reporting second quarter results that beat Wall Street estimates and raising its full-year profit forecast, pointing to stronger margins and lower tariff costs. GM CFO Paul Jacobson joins surveillance at 8:15 Eastern. The London Stock Exchange announcing plans to introduce non-stop trading next year. A new venue called LSE 24 will offer, quote, near continuous trading outside of regular market hours. Exchange-traded products will be the first available assets to trade on the platform. A disappointing result for Nike at the World Cup. Both Spain and Argentina wearing Adidas in the final game. In a memo seen by Bloomberg, Nike's vice president acknowledging production delays and criticism of the company's jerseys. He went on to say, quote, Nike has an outsized opportunity to lead and own women's football. And that is your Bloomberg brief. John.
Vonnie, thank you. Nike did not have a good World Cup. Kind of invisible, right outside of the one commercial.
I was just going to say, I remember the commercials, but that's about it.
Well, on the commercial front, I think Adidas owned that too.
Yeah.
Right.
And Adidas for sure owns, I feel like Adidas is more of a soccer company.
Without a doubt. Up next on the programme, ushering in a new fiscal era.
We will make this moment a circuit breaker for Britain, bringing a new political model and a new economic model.
Up next, Jane Foley of Rabobank, live from New York City. You're watching Bloomberg TV. So here's the bounce this morning, up 0.5 on the S&P, up 1.4 on the Nasdaq. On the Russell this morning, higher by 0.7. In the bond market, some stability. 2s, 10s and 30s stateside look like this. 10s around 460. 10s in the UK. Some jitters in the last 24 hours, north of 5. Let's talk about the UK. Under surveillance this morning, ushering in a new fiscal era.
We will make this moment a circuit breaker for Britain, bringing forward the biggest changes in the last 40 years. A new political model and a new economic model.
So here's the latest this morning. The UK Prime Minister Andy Burnham naming former Defence Secretary John Healey as Chancellor of the Exchequer, fueling speculation for increased military spending. Jane Foley of Rabobank writing the following: against the backdrop of an already high tax burden and a squeezed fiscal position, we see risks that market optimism will have started to run dry by the autumn. Jane joins us now for more. So Jane, welcome. Let's park the vibes. Let's focus on the policy and let's focus on the structure of this UK economy. What is it about the British economy that leaves any leader right now in a position where they face imminent failure?
Well, of course, the debt as a percentage of GDP, nearly 100%, just a little bit lower than that. And of course, you've got to think about the structure of that market too. The UK has a very low savings ratio. It's got a current account deficit, and that makeup can make the debt market really quite jittery, more so than other markets that are perhaps insulated by a high proportion of domestic savers. So the gilts market in the UK can be jittery. I think we all know the history of Liz Truss. Some commentators would say, well, you know, there's been a premium on gilts since then. There's, you know, long memories perhaps in the markets. And we're worried. We're worried about Burnham, how he can fund his plans, because what we've effectively got is a government that's moved further left. Now, Burnham has said that he will stick to those fiscal rules set by Rachel Reeves, but even that, there's a little bit of woolliness about that. He said yesterday he would use flexibility, and that might mean that he would fund perhaps some of those infrastructure projects he wants to do by putting that debt on the books of maybe public financial companies. So the market's trying to figure this out. Where is the money going to come from in order to finance his plans?
Well, let's talk about one dimension of policy. Let's discuss energy. So, Jane, there is the North Sea oil. Let's say we have a different perspective on North Sea energy in the UK. And let's think about what that could mean for the balance of payments position of the United Kingdom and the potential tailwind that might provide for sterling over time. How do you, as someone in the FX market right now, think about that?
Well, I'm no energy strategist, but what we've been told for years is that a lot of the cheaper reserves from the North Sea are depleted anyway. And of course, you've got to go back to the 2024 Labour Party manifesto. And, Burnham has said that he will maintain that. And that means no new licenses. So what we're talking about potentially under Burnham is a sort of a stretching of existing licenses to use that. But again, you have like the eco front. The UK has actually been ahead of many other countries in Europe, or most other countries in Europe, in terms of taking out coal, in terms of burning that to use electricity. We use less gas than some of our other Western European countries too. And a lot of people would still argue, well, you know what, we need more investment in nuclear, which is coming, but clearly that takes a long time. And we have stepped up, wind, for instance, solar, etc. And there's a lot of pressure, as we all know, on Europe in particular, to get that right. And there has been really since 2022.
Jane, what's different than the Starmer policies? Some of these just sound like repackaged Starmer policies with a different CEO at the top.
Well, we need to wait the detail. Now, the things that he really is talking about perhaps is trying to unleash productivity from some of the northern towns. Now, you could say that would be a great solution, because if you look at the UK, London, the southeast, really productive place. But if you go elsewhere in the UK, well, you do not get that. So you could say, yeah, you need that investment to really unleash that productivity. And productivity, if we were to get it here, would really be the answer to many of our problems. We'd have greater wealth, we'd have greater, growth, for instance. That would really, really be helpful. The problem is, we all know it can take 10 years or so to really make infrastructure investment work. He's got 3 years to the next election. And this is where it gets really tricky, because if you look at the opinion polls are suggesting if there is an election right now, well, the country would vote reform, which is right. And right now, the Labour Party is sort of neck and neck with the Tories, which is also, centre-right party. And as Tony Blair pointed out in his essay a month or so ago, well, it's unusual, isn't it, that when the electorate goes right, the Labour Party thinks the solution is to go further left, which is where Burnham comes from.
Let's see if they wait 3 years for that election. Jane, thank you. Jane Foley there of Rabobank. Sterling this morning at 134, the UK with its own problems. Coming up next on the programme, Emily Roland of Manulife, John Hancock Investments. We'll catch up with Ariana Salvatore of Morgan Stanley, Ted Mortonson of Baird, Joe Davis of Vanguard. The second hour of Bloomberg Surveillance is just around the corner.
I think that the consumer is displaying real resiliency.
Yields are quite attractive. I think the Fed will eventually end up on the side of not tightening.
Fed, maybe they hike, maybe they don't.
The orthodox policy response to a supply shock of looking through it is probably right.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action scores look like this. Equity futures bouncing back from 3 days of losses on the S&P, up by 0.5. Outperformance in the tech sector on the Nasdaq this morning, higher by 1.4. In the bond market, some stability after twos closed above 420 again. In yesterday's session, we hold that level this morning, 420.21, with crude. It's been volatile. Brent and WTI. Brent still elevated 90 and up 1%. WTI 84 and up 1%. And we face significant two-way risk working through this week.
So the two-way risk is, on one hand, potentially there's a 10-day ceasefire that's floating out there. And there's some encouraging reports this morning that Iranian mediators are in Pakistan to discuss potentially this off-ramp. The other risk is the strikes continue, and already we hit 10 days of continuous strikes from the United States and in Iran fighting back in terms of going after U.S. military installations and some desalination plants of Arab partners, and also another choke point in the world for global crude potentially getting hit if the Houthis decide to get involved.
Escalation on the table in the last 24 hours. The middle option, the messy status quo, comes with its own problems. We've caught up now with countless professionals in the energy market who are making the point: stop looking at the price of crude, look at the price of products, look at the level of inventories, and think about the problems that could materialize in the months to come if this situation continues.
And there's already problems right now, today, when it comes to that product market. You see this in the United States with $4 a gallon, peak driving season. Potentially, it's only going to get worse. What is going on in Russia? They have a diesel export ban right now. China, yes, as Francesca was talking about, we talk about the soft imports there's been on crude. But when it comes to the actual product, they are hoarding. This is where the problem is right now. And this is why Jeff Curry says, stop with the noise on Brent and WTI. That's not where the action
I think the audience are just like, stop with the noise. I can feel it. Every time I look down the barrel of the camera and talk about this story, people throw their breakfast at the TV screens, throwing their smartphones on the floor. We've heard it all before. We don't care. It doesn't matter. It hasn't mattered over the last several months.
What would you rather than us talk about tariffs this morning?
Let's
because
not do
that's
that.
happening once again as well when it comes to Canada.
50% on the table for Mark Carney and the crew up in Canada. Where did that come from?
For milk, hockey sticks.
The hockey stick gets just,
beer,
honestly,
plywood. The hockey sticks is a massive troll, clearly.
crazy troll.
But it is potentially, I think, this is more of a negotiating tactic. They don't even come into place for about 30 days after the president signs them. They are in the middle of USMCA discussions. It is interesting, as you said, the timing. They just had this wonderful outing together to watch the World Cup final.
It's a fantastic day. It was a perfect one, right? All sitting together, playing happy families, then bang, following day, tariffs. Now, I get it. You don't care because the earnings have been so good, and the earnings have been absolutely fantastic for Q1 and potentially Q2 as well. We'll get more reporting later on in the next week or so. We'll hear from Alphabet tomorrow. Look out for that. Tesla and IBM in the mix too. Intel on Thursday. They'll be in focus. GM already out this morning. GM would have beaten a race. GM would have beaten a race. The numbers for corporate America still absolutely fantastic.
They're holding on, and not just that, the bar has been high, and a lot of them have been clearing it. So GM, a fantastic quarter for them. When it comes to what's going down the rest of the week, you call it the big boy earnings. It's true. Alphabet and Intel are going to be so important. And I think even now more so after this report out of Japan on what TSMC is doing. They are looking at raising prices by 10% for 2027. The hyperscalers are going to have to make sure that they can reach that spending.
Demand is great. Pricing power is pretty incredible for a handful of names right now. Equity futures on the S&P near session highs up by 0.5%. Coming up this hour, we'll catch up with Emily Roland of Manulife on why earnings remain the key driver for markets. Ariana Salvatore of Morgan Stanley as US and Iranian forces exchange strikes for a 10th consecutive day. And Ted Mortonson of Baird as TSMC is reportedly planning to raise prices by up to 10% in the next year. We begin this hour with stocks rising as investors begin shifting focus back towards mega cap earnings this week. Emily Roland of Manulife writing, stock returns may not match the gains of the past 3 to 5 years, but earnings remain the fairway. Investors may need to become more comfortable taking a full swing with growth assets over the long run. Emily joins us now for more. Emily, appreciate the golf analogy. It's good to see you. Let's get into the market and we'll focus on that. Earnings have been fantastic. The bar's crept higher. Why do you think the bar is not too high this earnings season?
Yeah, companies have proven that they can surpass that bar. But the problem, John, now is that the earnings are amazing story is already an old story. All you have to do is turn into Bloomberg Surveillance to hear it. And now it's like, don't let me down. And we have seen companies absolutely crush it down the fairway. You know, we're 10% through earnings season, 51% earnings growth. Like, that is amazing. You look at financials so far, we're looking at 36% earnings growth. The bar was 5% to start the quarter, but we are seeing some company-specific challenges. They're not necessarily related to the macro environment, but if companies are disappointing, they're issuing guidance that's not favorable, you're seeing those stock prices punished. So the bar is high, but so far so good in terms of surpassing it.
IBM is a good example of that, maybe a rare example of that, but if you miss, you'll get obliterated in this stock market. If you won, you will get absolutely crushed. Emily, what do you think the setup is for individual parts of the tech sector then in the next week? What are the parts of the market you're worried about, the parts of the sector you're pretty constructive on?
Yeah, it's going to be absolutely critical over the next couple of weeks to see these heavy hitters in the tech space. You know, semis have continued to just throw up these amazing earnings. We're looking at 100% earnings growth quarter after quarter. It's really just remarkable. And prices are reflecting that. So we're watching things like the Kospi index right now to see how these South Korean exports are faring. You look at South Korean exports right now, they're up about 70% year over year. That is a record. And that is telling us that demand remains exceptionally strong. But can prices keep up with that? Some of these moves have been absolutely parabolic. So again, that bar has to be met. You know, we look at the large cap growth space, you know, some of those big hyperscaler names, they haven't seen quite the same price appreciation. So in that case, the bar may be a little bit more manageable here. But overall, 50% earnings growth in the tech space, that is a really high bar. I like looking at places that have a lower bar. Industrials, for example, expected to see less than 10% earnings growth this quarter. Again, financials, the 5% expected. We are looking to some of those sectors. Healthcare is another one where the bar is very reasonable. And those are areas we are looking at in order to diversify from some of those elevated expectations within technology.
When you're looking at diversifying, though, and you see elevated crude prices, potentially, does that worry you?
It does in some cases. And, you know, theoretically, the idea is that you should see some multiple compression if oil prices keep rising and the cost of capital becomes prohibitive. But we've looked at what happens in higher inflation regimes to stocks. And in a 3 to 4% inflation regime, that's actually the sweet spot. Companies are able to raise prices right now. We're seeing that in some of the earnings results and some of the guidance that's out there. In particular, mid-cap stocks and value stocks tend to do particularly well during those higher inflation regimes. I would say, Annmarie, it's all fun and games until the Fed has to pump the brakes. And right now, inflation is not hot enough to really see the Fed doing that. You know, you look at the softer employment report, you look at the lowest CPI data that we've seen in 6 years, that doesn't exactly scream Fed hike. But if oil prices do remain elevated, that risk comes back into the table. And that's frankly when the party starts to look like it may be over.
But you hear from the likes of Cleveland Fed President Beth Hammack saying that businesses, consumers are actually going to her and saying, you guys need to do something about inflation. Does that make you nervous that at some point in the next few months, the Fed will end up having to hike interest rates?
It does. You know, it's certainly on the table. And that's the biggest concern we have, because right now we have these two mega forces colliding of central banks, you know, becoming a little bit more hawkish at the margin at the same time that there's this massive need for liquidity with this huge AI earnings boom. So those two things coming together are really critical here. But when we look underneath the hood of the inflation reports that we're dealing with, yes, PPI was a little bit hotter. I would say that probably isn't necessarily a bad thing because it means businesses and manufacturing is booming in the United States. But the key to us is looking at shelter. It's all about shelter. Housing is the economic cycle. And if you looked at that last CPI report, shelter was up 0.1% year over year. That is remarkably low, and it's finally starting to reflect some of the real-time data that we're watching within the housing market. The NAHB housing market index, it slowed to its lowest level in years the other day. Home builder sentiment is slowing, et cetera. So we think that that can keep feeding into the inflation. It's 35% of CPI. So we think that slowing shelter component, which, you know, look, mortgage rates still 6-7%. That is not helping the housing market recover. That can help dampen any inflation that we see coming from higher oil prices or from the good side of the economy.
Emily, this is the challenge this Federal Reserve has got. The drivers of inflation right now are arguably rate insensitive. And if they hike, I'm just going to pick a bad phrase, I'll pick a different one. They're arguably just whistling in the wind. I don't think, Emily, it makes much of a difference.
No, and I think that's why it's so notable that Warsh has said that these things are mutually exclusive. The employment side of the mandate and the inflation side of the mandate. That's a very different tone than what we've seen historically, and we think that that doesn't necessarily play out because if the Fed does hike, they're not really solving the supply side problem. There's not much the Fed can do on that front, and they may risk the employment side of their mandate if this cost of capital becomes higher and company margins potentially get compressed. It's not our base case. Margins are great. Earnings are phenomenal, like we've talked about. But if that cost of capital goes up, that is the Fed that's going to really kind of be pulling the punch bowl away from the party.
Whistling in the wind is difficult. Emily, thank you. Appreciate it.
You.
Emily Roland of Manulife, John Hancock Investments. I was going to say something else. I want to say the other thing. You mentioned Cleveland Fed President Beth Hammack a few times. I want to share this quote with our audience. This was in a LinkedIn statement going into the weekend. There is no conflict in our mandate. Inflation is too high. The labour market is right around my level of maximum employment. Then the line you mentioned. For the first time in my tenure, I'm hearing from businesses who say they think we need to take action to curb inflation. That's the push, the pressure they're under at a regional Fed right now.
And that's pretty direct. You hear a lot of Fed officials talk about weighing the risks, upsides and downsides. What you hear from Beth Hammack is business executives are coming to me and telling me to fix it, and that they just see inflation as the sole problem right now. And that is her posture going into next week when they have this big family fight at the Federal Reserve.
Which might result in some dissent. Few voting members, including Beth Hammack, increasingly hawkish, even with that downside surprise on CPI just a week ago. Bond yields this morning around 420 at the front end of the curve. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John, thank you. Officials from Iran are reportedly meeting with mediators. The Associated Press reporting the meetings are taking place today in Pakistan. Reuters reporting a 10-day ceasefire has been suggested. The US and China are planning AI talks in September. Reuters reporting Treasury Secretary Scott Bessent will be leading the US delegation. The talks are set to take place before Chinese President Xi Jinping visits the White House later in the month. And JP Morgan CEO Jamie Dimon reiterating his criticism of the UK's bank tax surcharge. Dimon saying the tax hikes could drive capital away as they lead to an uncompetitive tax system. He says UK politicians should be worried about the number of companies that have delisted from London in recent years. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the programme, continued escalation.
Iran is very much intent. They want very much to make a deal. We're going to win one way or the other. We're just ending it. We control the Strait. They don't control anything.
Up next, we'll catch up with Ariana Salvatore of Morgan Stanley from New York City this morning. Good morning. So it was a struggle yesterday, a struggle to bounce from 2 days of losses to kick off this trading week, and it became a third day of losses on the S&P. Here's the bounce so far this morning. We'll see if it holds. We'll see if it sticks. Equity futures so far on the S&P up by 0.5. Some outperformance on the Nasdaq. The Nasdaq 100 higher by 1.3. In the bond market, I've mentioned this a few times. Twos closing above 420 for the first time since we received CPI last week. A downside surprise, and yet we give up the rally. In the bond market, twos back to 420, north of that level of 420.85. This in the commodity market is not helping. Brent crude, WTI. We've talked about the monster drawdown in global inventories. Global inventories between March and May dropping some 360 million barrels. That's the cushion for crude. When you speak to the professionals in this sector right now, they will tell you, you don't consume crude. You consume crude product. And we have bigger issues with crude product.
Yeah, a lot of risks out there when it comes to crude product, including if the Houthis were to get involved and we would see potentially some hits in the Red Sea. What is going on in Russia in terms of export ban on diesel? The fact that China is still hoarding product. And a viewer writes in and says, look what's going on in the strategic Black Sea oil terminal. The fact that now they're having to halt some exports there because of Ukrainian drone strikes. There are a pocket of risks around the world that is putting tremendous amount of pressure right now on the product market.
It's not talked about enough, developments in Russia. The exports of diesel, right? Banned in the last few weeks or so.
It's a big deal.
That's going to have a big impact.
a massive impact because Russia normally would be exporting a lot of this to the global market. And right now, what they're seeing in terms of Ukrainian drone strikes on refineries more deep into Russian territory, and people are lining up. If you look at individuals in Russia and they send you some pictures, you see individuals lining up at gas stations. There's a real problem there, so having to cut off these exports right at the moment.
Just been this quiet, uncomfortable rally on crude. We sold off at one point on Brent. I'm talking about Brent. We were threatening to break into the 60s, and now we're back in the 90s, just like that, very quickly. $90.35. Under surveillance this morning, continued escalation.
Iran is very much intent. They want very much to make a deal. We're going to win one way or the other.
To me, I think it's over. I don't want to deal with them anymore. They're scum.
This is a far bigger job that we're doing. We're just ending it. We control the Strait. They don't control anything.
So here's the latest this morning. Crude prices hovering around $90 a barrel as US and Iranian forces exchange strikes for a 10th consecutive day. The Associated Press reporting that mediators and Iranian officials are meeting in Pakistan right now, while Reuters is saying a 10-day ceasefire has already been suggested. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John, good morning. Well, we're getting these signs that mediators are actively working to prevent further escalation, though a White House official tells us that the U.S. strikes are expected to continue until President Trump chooses a different course of action. And at this point, we've gotten very few public indications that Iran is willing to let up its leverage when it comes to the Strait of Hormuz, attacking another tanker overnight, this time linked to Kuwait. There's new data out from research firm Kepler that finds the average amount of ships transiting from Friday to Sunday was about 10 vessels per day, and most of them, if not all of them, use the route that is being approved by Iran and not that U.S. coordinated route that is closer to Oman. Now, just compounding the risks, as you've been discussing on this program, is the threat from the Iranian-backed Houthi rebels to institute this immediate maritime blockade of Saudi Arabia, as we know that the country has been using its pipeline to get more supply to market via the Red Sea to the tune about 4.5 million barrels per day since the conflict began. And Saudi Arabia is taking the threat seriously, saying in a statement overnight that they will take, quote, all necessary measures to protect its ships. Now, John, as regional allies are working to try to get some sort of resolution, we got this new reporting this morning that Iran's president says that he is in closer touch with the country's supreme leader, which some experts say could help smooth the path for diplomacy.
Tyler Kendall with the latest. Tyler, thank you. I want to pick up on that last line. If Lisa was here, she'd ask a question she often asks. When we negotiate, who are we negotiating with? I think that last line from Tyler was important.
Yeah, and also it's very odd because we have not seen Mojtaba Khamenei. We have not seen the new supreme leader. And now you have the president, which is very domestically focused in Iran, saying, oh, well, I have a lot of contact with him. Well, do you? This is where the questions really come from. At the same time, there's been a lot of analysts in the U.S. government that they say they see evidence of potentially a debate taking place within the regime. Well, is that properly happening? Is there a real debate between hardliners and then those that maybe want to go to the negotiating table?
Here's the take from Ariana, Salvatore and the team over at Morgan Stanley. They write the following. We see the Strait normalization requiring 65% of flows to get markets back to balance, keeping our oil forecasts above pre-conflict levels, but below $90 a barrel. Ariana joins us now for more. Ariana, good morning. It's good to see you.
Morning.
Let's talk about those negotiations. I'll ask that question to you. Who are we negotiating with?
Good question. I mean, that's one of the key uncertainties when it comes to the implementation and seeing through the Memorandum of Understanding. Maybe just to back up and provide a little context, maybe why we're not necessarily surprised that this MOU sort of fell apart, right? We saw 4 clear paths to escalation after it was signed. First, implementation, and not just implementation, but sequencing. What happens first? Lifting the blockade, opening the Strait. How do you lift decades of sanctions and reverse that policy? So that's the first question. Second question is, where are the Israeli and U.S. objectives diverging, right? That's a really important component to keep track of. For Israel, the Strait of Hormuz doesn't matter as much, right? For the U.S., that's obviously a key concern. Israel's more concerned with missile launcher capacity, nuclear, as you could guess. The third, where is Congress in all of this? We know that there are some hawkish members of Congress that have pushed back against the deal itself, saying it wasn't good enough, didn't go far enough, and they will not have an explicit role in approving whatever MOU comes forward, nor did they approve the JCPOA, the 2015 deal. But we are getting NDAA discussions going in Congress. So to the extent that lawmakers want to push back and make their preferences known, they'll have a platform to do so. The last thing I would say is on nuclear itself. This was a 60-day agreement. And the last time we saw nuclear negotiations, they took something like 20 months. So with that backdrop, it's not necessarily surprising to us that we saw this type of escalation. Who are they negotiating with? It's just one question among many.
And we're in the 60 days technically, and already we're back to what honestly is war, 10 days of strikes. Do you track where the oil price is going depending on what the president is going to do next? Is there a threshold for him that then potentially he says, okay, I'm going to lead into the diplomatic route?
It's very hard to see where those incentives might overlap. When we think of this from the domestic standpoint, it's really gas prices, right? Obviously affordability, key issue heading into the elections. And when we look back at prior elections, it's not a perfect, rule of thumb, but one thing we go by is the 3-4-5 rule. So gas national average around $3, good for the incumbent, right? $4, politically a little bit dangerous. 5+, that incumbent is likely to lose that election. So I think if there is a metric to track, that would be it, right? But overall, I think there are many incentives that are sort of driving the president's strategy here. And as you guys said before, you don't consume crude, right? It's just one factor of many.
What are the policy proposals that potentially this administration or Congress are going to look at if we continuously march higher from $4 a gallon?
I think a lot of the options have been on the table since the start of the conflict back in the spring of this year. The clearest things, temporary sanctions relief, right? So that was not just for Iranian oil that was on the water, but also some Russian oil, so secondary sanctions too. You saw a Jones Act waiver. You saw tapping of the Strategic Petroleum Reserve, right? Those levels are low relative to where they started in the conflict. But again, these are all mitigation measures. They're not really going to be enough to meaningfully offset this sort of increase.
I know this is a difficult question to answer, but do you get the sense that maybe this situation is more important to the president than the midterms? We often have guests that come on the programme and talk about the midterms. He's got to get this dealt with before the midterms. Does he?
I absolutely think this is not the primary concern. The midterms, not the primary concern for President Trump. As we've said on this program before, there's plenty that remains within his control following the midterm elections, right? So tariffs, geopolitics, foreign policy, immigration controls, all of that he can continue doing. And the historical precedent suggests the Democrats are probably going to do pretty well anyway. So if you think about that, I think the bar is relatively lower for President Trump in terms of keeping House control, keeping Senate control. I think that that's not the only thing he's considering when it comes to the conflict.
Ariana, it's good to see you. Thanks for being here. Thank you. Ariana Salvatore of Morgan Stanley. That last note I think is important. We often hear that he'll get this fixed because he has to before the midterms. Does he?
I'm looking at that quote he said a few months ago. Not even a little bit, the president said when asked to what extent Americans' financial situations were motivating him to make a deal with Iran. The only thing that matters when I'm talking about Iran is they can't have a nuclear weapon. Not saying he doesn't care about Americans' financial situations, just that he cares about this a lot more. And he's not going to let Americans' financial situation, potentially higher gas prices, impact what he wants to do with Iran. At the same time, we have seen this president definitely move towards wanting to take the diplomatic route when available.
That's the bias of the market too. And when you're confronted with two-way risks like we are this morning, the prospect of, say, the Houthis shutting down the Red Sea and blocking Saudi Arabian shipping, or the proposal for a 10-day ceasefire, the market will put more weight on the latter than the former, precisely for that reason.
And I lived it in real time with the president in Turkey. In the morning, he started out on the final day saying the ceasefire is over. They started bombing once again Iran. Then when we came to the press conference at the end of the day and reporters were asking, are we back to all-out war? He would not commit to that. He said it wouldn't be a long time.
Crude at 90, WTI around 85. Up next, we'll catch up with Ted Mortonson of Baird, as TSMC is reportedly planning to raise prices by up to 10%. Plus, Yahara has your morning movers. Software stocks falling across the board following a series of downgrades. This is the equity market picture so far this morning. Then good morning to you. Equity futures on the S&P bouncing back, on the S&P higher by 0.4, on the Nasdaq up by 1.2. The bar for earnings is sky high. The earnings continue in the next 24 hours. GM, we'll talk about that in a moment. A beat and a raise from General Motors earlier on this morning. Name the bank. In the last several months, they've probably upgraded their price target on the S&P 500 from Goldman to JP Morgan, from RBC to UBS, on the back of very, very positive earnings. This came from Matt Kettner of HSBC. Here's the warning. A man who has been very bullish on this market for a long time. He said it may well be time to reduce risk in portfolios after the peak earnings season in 2 weeks' time. Is this as good as it gets?
And he was talking about positioning being more stretched when he was on Bloomberg earlier today. And then he says, when do you get out? That's really hard to time right now. And that's what a lot of individuals are dealing with right now. And on top of that, you have a lot of risks coming into the market. we have three today that the market is digesting or potentially just shrugging off when it comes to Iran. More tariff talk from this White House, this time on Canada. And then, of course, TSMC raising prices going into 2027.
Max Kenneth joining the programme tomorrow morning, 6 a.m. Eastern Time. Don't miss that. Let's turn to the bond market. Switch up the board. 2s, 10s, 30s. Yields look like this. Here's your yield curve stateside. 2s at 420.64. 10s around 460. 30s around 5%. How many times have you heard me say that in the last few weeks? I've said it repeatedly because this bond market has been very, very range bound with yields at the upper end of the range. The why? Many reasons. Here's one. Check out crude. The bounce back we've seen in crude, it's been quiet, it's been stealthy, but you've gone from the 60s on WTI to 85. You've gone from the low 70s on Brent into the 90s. We're talking about a $20 move in some cases very, very quickly in this energy market.
Sometimes you would see these moves across a number of years, not just weeks. And this is all stemming from the conflict in the Middle East. And when it comes to Tehran and Washington right now, the main focal point on what they are trying to get control over is who controls the Strait of Hormuz. And that is why we've had this breakdown in the 60-day MOU. Potentially there's an off-ramp for a 10-day ceasefire, or potentially this messy situation gets a whole lot worse if the Houthis come well on their threat and start to block some of the product and crude that is going through the Red Sea.
A 15% plus rally on crude just last week, up again this morning. 2 hours away from the cash open. Let's get to your morning movers. Yahira has more. Hey, Yahira.
Hi, John. We start with the earnings that we've gotten this morning, and GM shares up 1.6% in the pre-market after the automaker posted a beat and a raise thanks to strong pricing on its more profitable trucks and its cost-cutting measures. But I will note that shares were in the red earlier, underscoring some of the concerns that investors have with this automaker. U.S. car sales are still declining. Plus, the company is relying more on pricing power rather than seeing stronger demand for its trucks. Meanwhile, another company to report earnings was the credit reporting company Equifax, and shares are plunging 11% in the pre-market after it struck a more cautious tone on the rest of the year, lowering the top end of its profit forecasts. And investors are punishing it for that, even though it beat on second quarter earnings. And we end on the software stocks. They are under pressure with names like Salesforce down nearly 4% in the pre-market after Morgan Stanley downgraded a number of them. The call reflects a broader shift in sentiment that we've seen in software, where investors want more proof that their investments in AI are translating into actual growth. And Morgan Stanley says that it is not seeing that with these names, even though they all have a big AI push. And I will note, Intuit shares down 53% year to date, John.
Brutal stuff, cut in half. Yahira, thank you. Appreciate the update. More from Yahira in our next hour. On our radar this morning, day 10 of direct strikes between the US and Iran. Ceasefire talks are reportedly underway, with the Associated Press this morning saying an Iranian official is meeting with mediators in Pakistan. Reuters reporting a 10-day pause has been suggested. Elsewhere, the president threatening a fresh 50% tariff on a range of Canadian goods. Washington highlighting unfair treatment of American products as reasoning for the levies. The tariffs are set to take effect in 30 days should the president follow through. And finally, General Motors rising in the pre-market. The automaker exceeding estimates for the second quarter and raising its full-year earnings forecast. The GM CFO, Paul Jacobson, joining the programme at 8 a.m., so about 30 minutes from now, to break down the numbers.
I'm really excited to speak to him because there's so many issues right now affecting GM and whether or not you're a massive automaker in the world. I mean, you wake up this morning and you see fresh tariff headlines between Canada. I know that's not affecting autos right now, but you have to think, is this potentially going to be a problem given the United States, Mexico, and Canada are renegotiating USMCA? You have the fact that they have had EV losses. What's going on with that business? And the fact of the matter is, it comes down to people want pickup trucks and SUVs, and they have been having very aggressive pricing on that, and it's working for them.
So let's start with that last point. It's important. They've got pricing power for premium trucks. That's fantastic. At a time when gasoline prices are pushing higher and doesn't seem to be slowing sales right now, they've increased the guide. We'll start there, I think, for the conversation. The powering of margins, the engines for margin growth right now, they seem to be very constructive on that. And I think we need to get into that too. You talked about tariffs. Higher chip prices, another factor as well. They're going in the wrong direction too. So trying to work out how this company that's navigated these issues really quite well in the last 12 months, how they plan to do the same again over the next 12.
And it costs a lot of money to fill up an SUV and a pickup truck. And if gasoline prices are going higher, is there a threshold where potentially they would have to not raise prices anymore, or potentially will they see pushback from consumers? We know they're not interested in straight EVs. Potentially, is there more of an increase they see on the horizon for hybrids? Or are people just going to put off buying brand new cars?
Based on the numbers we're seeing this morning, we're not there yet. GM this morning higher by 1.7%. Looking forward to the conversation with the GM CFO in 30 minutes' time. Let's turn to tech. Taiwan Semi reportedly planning to raise chip-making prices by up to 10%, according to Nikkei. The changes will take effect next year and cover both advanced and mature semiconductors. Ted Mortonson of Baird writing, "We're at the front end of a super cycle, but the spend and funding requirements are massive." Ted joins us now for more. Ted, good morning. Good to see you. The spending and funding requirements are huge, and these companies, a handful of them, are making massive, massive profits. Ted, to your point, and you've noted it in the note you've put out and sent over to us, we've seen great numbers from Taiwan Semi. We've seen great numbers from Samsung, from Micron. What does the market response to those great numbers tell you about how high the bar is this earnings season?
The bar is extremely high, and all these companies have got to absolutely annihilate the number, like Vicor just annihilated the number this morning. The issue, I think, is a little bit different. If you look at TSM, they increased their CapEx from $56 billion to $62 billion. To put that in perspective, CapEx in 25 was roughly $41 billion. On their call, they did indicate that some of that increase was due to higher equipment costs. So they're seeing the inflationary impact on their model already. So they've got to pass on all these additional prices. And from my perspective, I think this is a blind side on the tech market. If you look at the 10-year Treasury at 4.6%, if we lose control of the long end, I think cost of capital issues will become front and center with the street.
Ted, let's get into that. You've mentioned this the last time we spoke as well. The long end of the curve, at times over the last few years, has had these moments where it's felt untethered. Are we close to that moment now? And can you just build out what is the relationship between that and the things we're talking about in tech?
So we're not playing chess on 4 levels anymore. We're playing chess on 10. This is probably one of the toughest markets I've seen on trying to balance the macro inputs. If you look at oil at $90, that's massively inflationary. If you look at the semi trade, just the AI infrastructure build, the demand on memory, for example, due to the impact on inference and the memory loadings, has been biblical. We have never seen a 300% plus increase in memory. So we're seeing price increases everywhere in the semi-food chain, and they're significant. Memory I touched upon, there's 25 companies that are seeing their gross margins being hit by memory. Second of all, if you look at advanced logic, what TSM does, they derive about 33% of their wafer revenue from the 3 and 2 nanometer nodes. This is where manufacturing is going, and they're the only game in town right now at 2 nanometer. It's de minimis as it relates to their total revenue, but it's going to be a massive manufacturing node. For them to raise prices here, I guarantee you, in the boardrooms of NVIDIA, Apple, Qualcomm, AMD, I'm sure they saw this coming, but they've got to pass on these costs. And at some point, we have the discussion of elasticity of demand.
So, Ted, let's get into what it means for fixed income more broadly, and we'll start there, and then we can talk about the potential for demand destruction further downstream. This is what I've been thinking about. I know you've given it thought as well. These companies are spending a tremendous amount of money. Clearly, it's creating inflation pressure, price pressure that needs to be absorbed somewhere by someone. That threatens to push up bond yields, might threaten to push up interest rates at certain central banks as well. At the same time, we've got these massive funding requirements, financing needs of companies coming to market, both through equity and through debt. The struggle I've got right now, Ted, does this put the squeeze on the Treasury market? Does the Treasury market put the squeeze on those financing requirements? Is the tail wagging the dog wagging the tail? Which one is it?
I don't think we've ever been here before, to be honest with you. I mean, I'm seeing estimates of $1.4 trillion of funding next year. We've never been here before. This is a totally different cycle. And when you've been doing this as long as I have, you always try to look around the corner of what's new, and that is new. that funding requirement is not bigger than a breadbasket. It's the bakery. It is massive. So what I'm watching very closely, and I talk to portfolio managers sometimes 3 times a day, and what they're struggling with is attribution. And the worst thing that could ever happen to the tech tape is if we lose control of the 10-year, and let's just say hypothetically we go to 480 or even 5% worst case, there's going to be sector rotation. Look at the chart of Marathon Petroleum, and I am not an energy guy, but it's probably one of the strongest charts that you've ever seen. That's the definition of sector rotation. So what I'm watching going into Q2 earnings, all of these semi prints are going to be massive. They should be. That's number one. Number two, if you look at Micron, if you look at TSM, you look at Samsung as the underlying company, they blew out the number like nobody has seen before, and the stock traded down. If we get into the sell on the news on price perfection, there is going to be sector rotation. And where I'm watching very, very closely is if my PMs decide that, hey, I need to own energy, I need to own consumer staples, I need to own utilities, I need to move away a little bit from tech. The issue, Jonathan, is if you look past April 7th, the majority of the semi increases of 66%. I mean, that's a good couple years of performance in 3 months. The exponential increase on performance on the upside was historic. If we get sector rotation, my worry is it won't matter on fundamentals. If people move to different sectors, it's going to be a blind side for the general market if we lose control of the bond market.
Ted, layer that on top of the fact that we are seeing political pushback as well when it comes to AI data centers and potentially cheaper models coming out of China.
The investments that were made on OpenAI and Anthropic were done on the front end of the curve. I'd have your viewers go and do a deep dive on the partnership that Palantir and NVIDIA did. This is the definition of decrease in token prices via open source models, silicon, and the next generation stack middleware. You may love or you may hate Dr. Karp, but the guy's brilliant. And whenever he gets criticized, he's generally right. So the models are changing. Enterprises need lower token prices. They also need open source models that are not compromising their businesses. And this is what Dr. Karp went into great detail on a few weeks ago. So not only do we have a constant churn of the infrastructure changing, but I think you have to also look at how we are going to attain revenue, in the trillions to make up for this cost. There are 3 markets. I'll be very short. One is consumer. That's dead in the water. If you look at enterprise, that's 4% enterprise budget increases. Costs are up 25%. My clients are worried about the second half. And then you got the hyperscalers. They're spending like drunken sailors, and they will until they have to because they can pass on costs. Where we run into a problem is if the end customer just can't take it anymore. And we'll have to watch that in Q2 commentary.
Ted, after a conversation like that, forgive me for asking such a simple question. Give me a trade. With all of those concerns, what do you like right now?
I wish I was an energy analyst. I'm not, and I think that in tech there are three general areas. One is defense tech on semis. We're going to have multi-years of spend in defense. The Secretary of War is going in front of Congress asking for more money. There's no option here. That's number one. So semis that play in the defense area. In fact, some of the defense companies like an AVA or even a Kratos or some of the big integrateds, but also Palantir that plays into defense. I think defense is a great trade. The other one is semi-cap equipment. If you look what TSM just went up on their CapEx budgets of $62 billion, they're going to need a tremendous amount of equipment. The memory players are going to, whether it be SK Hynix, Samsung, or Micron, they are spending at historical levels on CapEx, on equipment. They're going to need a tremendous amount. So you've got, on semi-cap equipment, you've got 30% growth for the next 3 to 4 years. That's the other area. And then in tech, where I'm looking at is anybody that has pricing leverage will be insulated. And those are the foundries. So if you look at the 4 foundries, it's Samsung, Intel, and TSM being the gem of the group. And then from a lagging edge perspective, where some people are just not paying attention, is a lagging edge fab like Global Foundries, for example. They also have pricing leverage. So anybody with pricing leverage, some of the semi companies that are very specific in their silicon, I think they'll be fine, and they have pricing leverage. It's the commodities that I worry the most about.
That's a lot to chew on. Ted, it's good to see you, buddy. As always, thank you, sir. Ted Mortonson of Baird. I often go and listen back to the programme after the show, listen back to all the interviews. I'll listen back to that twice. So much to get through in that conversation. Let's get back to our top stories this morning with a look at your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John. Well, as you've been saying, Goldman Sachs says oil could trade above $120 a barrel by the fourth quarter if disruptions in the Strait of Hormuz continue. Now, currently, Goldman sees Brent at $80 a barrel in Q4 and $75 next year if tensions de-escalate. President Donald Trump says Benjamin Netanyahu will not be arrested in the U.S. Trump reacting to New York City Mayor Mamdani, who says his administration is in conversation about detaining the Israeli Prime Minister when he's in New York next month. The International Criminal Court has issued arrest warrants for Netanyahu on charges of war crimes and crimes against humanity. Neither the U.S. nor Israel are members of the ICC. Kraft Heinz is partnering with Disney. The Wall Street Journal reporting the deal will put Kraft Heinz condiments and mac and cheese in Disney's North American parks and resorts. The food giant will also be able to use Disney's characters on some of its products. And that's your Bloomberg brief. John.
Hey, Vonnie, thank you. Up next, AI's economic boost.
I think that investment in data centers and in AI generally do affect the demand side of the economy, and we can see it, and we can see prices move up. But unlike some of these other shocks, with a lag, it also affects the supply side.
Up next, Joe Davis of Vanguard. Live from New York City, welcome back to the programme. Under surveillance this morning, AI's economic boost.
I think that investment in data centers and in AI generally do affect the demand side of the economy, and we can see it, and we can see prices move up. But unlike some of these other shocks, with a lag, it also affects the supply side. Between the short term and the long term, it can have a disruptive effect, and we're attuned to that.
So here's the latest this morning. Big tech spending powering economic growth. Bloomberg reporting business spending in the first quarter advanced at the fastest pace in almost 3 years. Joe Davis of Vanguard writing outsized AI-related CapEx is expected to continue to offset softness in consumer spending. Joe joins us now for more. Joe, welcome. Let's talk about the contribution coming from the tech sector right now. How large is it, and is it still growing?
Oh, it's certainly large, and it is growing. You have to look really back to the late 1990s to see this sort of dynamic. Again, we have oil prices moving around. We have, consumer spending K-shaped. The fact is, follow the money and follow the investment cycle, and then that gives you a really good insight on the economic outlook. We are fairly constructive next year for growth.
Joe, how difficult is it for policymakers like the Federal Reserve to set policy for that when so much of this is out of their hands?
Well, and again, as you know, we've looked at this very deeply for 3 years. And, my urge and counsel to policymakers is not just look at the investment spent from a demand side, chips, data centers, but start factoring in a higher trend growth world from productivity, which we aren't fully seeing yet, but we will see if we're right, which means that you can have an acceleration in growth next year and it not be inflationary. It's boosting up inflation now, but it need not do that next year.
Joe, do you think this Fed, under this leadership, will wait it out, look through the potential spike in the short term and wait for the benefits further down the road?
Well, I think it's fair. I think you talk tough on inflation. That's easy. It's free, and why not do it? I think I'm hard pressed to see Fed tightening. We have a labor market that's stable, not accelerating. We have AI investment, to be sure. Again, is going supernova, and so you have to follow that dynamic. But ultimately, that will put prices down. It's just we have a cyclical run up here. So I think talk tough first, and then monitor. I don't think that's a sustainable inflation dynamic.
We've got an oil bounce as well. And Joe, for some members of the committee right now, the hawkish members of the committee, Beth Hammack of Cleveland being one, does that reintroduce some hawkish risk into next week?
Yes. I mean, again, I think you talk tough. I mean, the fact is inflation, as everyone notes, including the Federal Reserve policymakers, inflation has been above target for quite some time. And so, again, interest rates are in the rough range of where they need to be. They're certainly not stimulating economic activity. But again, with this investment phase that we're in, it's tough to derail that dynamic. And so I think you hold the line, much like the late 1990s. You may have some some touches up and down perhaps next year, but that is not our baseline. Our baseline is steady, talk tough on inflation, and then see the growth grow above trend.
I'm with you. I think a lot of people might agree as well. At times it feels like a communication exercise. Talk tough, keep inflation expectations anchored, wait to see how this plays out. Joe, let's talk about the talking side of things. I'm just curious to your reaction. If we don't have a news conference next week, would you care? Does it even matter?
Well, I think you also look at the forecast, whether it's during the meeting, in the press conference, what they publish, what they perhaps say afterwards. What we are laser focused on and have been is that we think eventually the Federal Reserve will start producing and expecting higher growth for the next several years. They will lag, I think, the data, but our projections are fairly clear and our conviction is rising that we are going to approach close to 3% growth next year, despite oil volatility and despite some sticky inflation. That is all being driven by the AI investment. And there's both risks and opportunities from the investment side, but I think that's where we'll see the Federal Reserve raising their expectations for growth, yet not inflation.
Joe, appreciate it. Thank you. Joe Davis there at Vanguard. It's kind of the message that at times Kevin Walsh has tried to articulate. News conference or no news conference next week? Joe didn't bite. Are we getting one?
I think you have to have a news conference. Isn't that crazy if you don't go out? I mean, you're there to work for the American people and you don't go out and greet the press?
Go back to what it used to be like. Set the tone early on.
What happens to the Fed show then? I tune in.
A shorter.
Okay, but it still
show.
exists. It's just shorter.
We read the statement. We move on. We take a break. Just like that.
Okay.
That work for you?
That works.
This is a market with a lot of variance.
The market's trying to figure out who's winning, who's losing.
I wouldn't be surprised if we see a little bit of a pullback in the CapEx.
It's really a balance of both the spending and the returns.
The demand's there and it's outstripping the supply.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. 90 minutes out from the cash open, equities elevated by 0.5 on the S&P, up by 1.4 on the Nasdaq, following a three-day slide on the benchmark stateside. That is your bounce this morning. In the bond market, 2s, 10s and 30s, your yield curve shaping up as follows. 2 still around 420. Elevated still this morning. We hold those levels. We hold these levels too. Brent and WTI elevated in the crude market. Brent shaping up as follows. $90, WTI around 85, up by more than 1 percentage point this morning. It is the itch that just won't go away. It's becoming a bigger and bigger pain for this market. The rally continues.
It's a risk out there right now, and potentially there's this fork in the road of what the United States and Iran are going to do. On one side, they can take this 10-day ceasefire, or potentially, as we've been talking about, this situation can get a lot more hostile, especially if the Houthis were to get involved and then cut off another key choke point when it comes to the oil market. And that's just one of the risks right now. If you look around the stories this morning, there are pockets of inflationary risk, whether it's not fresh tariffs when it comes to Canada. Also, TSMC talking about, according to report, raising prices next year.
In Q2, we could ignore this. We could ignore the situation in the Middle East for a bunch of reasons. The one that we're focused on this morning, global inventories were massive. We had this huge cushion that just gave us this warm comfort blanket in this equity market, together with amazing earnings. Amazing earnings plus decent GDP growth. Just spoke to Joe Davis of Vanguard, who's talking up 3% GDP growth next year because of the massive AI spending that is just going to continue through the next 12 months.
Right, it's going to continue. This is why, as you said, the big boys this week are going to be important. What does Apple say? What does Alphabet say? What does Intel say? But more importantly right now, the conflict in Iran is becoming a little bit more challenging, because what did we hear from Bank of America? What are we hearing from Goldman Sachs? If this continues and we see this more escalatory posture, we're looking at $100, maybe $120 when it comes to Brent. That's going to trickle down to much higher product prices.
Annmarie mentioned Alphabet. Alphabet reporting tomorrow. You'll hear from Tesla as well. You'll hear from IBM too. IBM pre-warning. Not great news for that company over the last week. We'll hear from Intel on Thursday. Then next week, the major players continue to report results. Coming up on the programme, we'll talk about another major player, General Motors. The CFO, Paul Jacobson, joins us with the automaker boosting its full-year outlook. We'll catch up with Yoder of JP Morgan, with chip makers rebounding ahead of a key week of big tech results. And Rob Sockin of PGIM calling for 3 interest rate hikes later this year. We begin this hour with stocks rising as earnings season shifts into full gear. The General Motors company exceeding estimates on the top and bottom line for the second quarter. The automaker also raising its full-year profit forecast by another $500 million. The GM CFO, Paul Jacobson, joins us now for more. Paul, welcome to the programme and congratulations on the result. It's a beat and a raise. I'm intrigued by the raise, Paul, so let's start there. What powered that raise this morning?
Sure. Well, good morning, Jonathan and team. Thanks so much for having us today. We're here to celebrate in large part the accomplishments and achievements of the GM team across the board. And I think the theme for the day is consistency. The team has really executed well over the last few years. Our go-to-market strategy, our inventory discipline, our incentives remain below the industry average across the board. The consumers remain resilient across the board as well. And we've seen some good tailwinds coming in the form of continued warranty improvement, our EV profitability journey, as well as pretty significant ramp in our digital revenues across the board. So when we look at that and measure it against even some of the macro headwinds that are out there, we felt confident raising our full-year guidance by another $500 million, effectively taking our outperformance in the first year and banking it, and really continuing to drive those results. But incredibly proud of the team and what we've been able to accomplish.
I can see that this morning. Paul, also the pricing power. Let's just sit on that just for a beat. The pricing power is impressive. We see gasoline prices back to $4 a gallon for the first time in something like a month. That problem has persisted through Q2 into Q3. You've got great experience of dealing with energy prices in your time over at Delta. It's different in the same seat over at GM. But can you describe how this works? When you see gasoline prices push up the way they have, what is the relationship between that and sales for General Motors?
Well, certainly the airline industry has a lot more ups and downs than the auto industry does as it relates to oil prices. But, what we look at is where is the health of the consumer? Where is the demand? And, our full-size truck sales are up 4% year to date. We expect that to be flat for the year, mainly because of production, because we're cutting over to the next generation of trucks, which we're really excited about. It'll be the most capable pickup truck we've ever produced, with a brand new Gen 6 V8 engine, as well as diesel options across the board. So, the success that we've seen in the last year of a generation of trucks is really unprecedented, and we've held in on price and demand as well, and that's remained consistent. So as we look at the overall energy price environment, it hasn't really impacted us. We're still selling full-size SUVs as quickly as we can make them, but we have a much broader product portfolio. We like to talk about here that, when you look at our crossover portfolio, the profitability is up 4x from where it was just in 2020. So we've gotten much more efficient at a broader portfolio to be able to meet customers wherever they are.
Paul, there's a line in the statement this morning from Mary, and it reads as follows, just a short quote: "We have multiple engines of margin expansion." Can we just sit on the margin expansion as well? I think this is really important. You know what we're like, Paul? We sit around this table every morning and we worry for 3 hours about a bunch of risks. You have to execute. We've spoken this morning about higher prices for chips, higher prices for energy, the prospect of increased tariffs. How do you make sure that you've got that cost discipline, to make sure you've got the flexibility as well, to see those margins and that margin performance continue, even with that price pressure coming from all directions?
Well, if you're pros at worrying, that might set you up to be a CFO someday. So keep at it, because we have to worry a lot, in our desk as well. But we've really also got to focus on what is that playbook that we can do, can execute to overcome. And I think what the team has really done is we don't make excuses. We're out there trying to find productivity where we can, enhancements across the board. So when you look at what the team is doing with quality improvement, and we've increased our warranty savings year over year from $1 billion, which we came out at the beginning of the year, to $1 to $1.5 billion. Our digital revenue, which we're really excited about, will be over $3 billion this year, and we expect to add 1 million new subscribers to our digital channels. So the team is really executing, and I think that's what's really different. When you look at 10 years ago, we were producing about $3 to $5 billion a year in free cash flow. Today, we're producing over $10 billion a year in free cash flow, and it's driving that efficiency in spite of what everybody would argue is probably a more challenging macro environment than where we were a decade ago. So we're really proud of these results, and we're continuing to execute and expect that the market is going to continue to see that.
Building on Jonathan's point, though, when it comes to TSMC this morning, they're looking at 10% higher prices next year for their chips. Do you at some point have to start passing chip costs specifically down to the consumer?
Well, we look at it in the entire equation. So coming into the year, we talked about $1 billion to $1.5 billion of inflationary pressures. We took that up after we saw the Iran conflict. Some of that is chip inflation as well. So our supply chain team is out there sourcing everything that we can. The first and most important thing is that we don't impact production, and we've been very, very consistent in that space. So while we are seeing some inflation, the opportunities and the tailwinds we have elsewhere in the business have been more than enough to overcome it. And that's why we've been able to get back into our 8 to 10% margin range in North America, despite $3 billion of tariff headwinds and other inflationary pressures as well. And, we think many of those opportunity sets that we have are going to carry us in with even more momentum into 2027 and beyond.
I'm glad you mentioned tariffs. I know you've done a lot to try to reduce the tariff bill, but are you having some PTSD this morning when you wake up and you see the president is talking about Canadian tariffs once again, which is key for your supply chain?
Well, there always seems to be something happening the day before earnings, but in this circumstance, this isn't anything that is impacting us. These new tariffs that were announced don't fall under Section 232, which is what covers autos. And and I think if we could encourage the parties, we would love to be able to get the deals done with Canada and Mexico. Mexico seems to be a little bit ahead of Canada right now, but I think a good trading bloc that meets all of the countries' needs is really important for us competitively. We've got a lot of capital that we've been putting in place, almost $6 billion into the United States to onshore production of both vehicles, full-size trucks, as well as the new Gen 6 engines that are coming in. We're increasing production across the board. We'll have over 2 million units produced in the United States when all this is said and done. So, I think we've been able to make adjustments, but, consistency is helpful, especially when you have a multi-year planning cycle.
Paul, I don't want to put words in your mouth, but is that a frustration for you and the team, for the executive team, for the whole team at GM? You just want to know the rules and you'll get on with it.
Well, I wouldn't classify it as frustration, Jonathan. I would just simply say, there's a lot of volatility in the world, and if it wasn't tariffs, it might be energy prices, it might be global conflict or geopolitical issues. And that's why I say as a team, we don't sit around and make excuses. We look and try to figure out what is that playbook that we're going to execute, where are we going to continue to try to find the opportunities to expand margin. And what the team has done is pretty remarkable. And it's now 3 years straight that we've delivered these types of results. And feel very, very optimistic about our ability to weather the storms wherever they might come from.
Well, it's a beat and a race this morning. It's impressive. Paul, we appreciate your time. You're always generous with it. Thank you. Paul Jacobson there, the GM CFO, following a beat and a raise of $500 million for the profit forecast this morning.
Yeah, beat and raise. They continue to deliver, and they are dealing with a number of headwinds. And I'm with you. There was a little bit of frustration there. I think he was just trying to say, we're lucky we're not in the middle of this latest tariff threat when it comes to Canada. But I was trying to get at the point of, do you just want this to be done with?
Yeah, I don't want to put words in his mouth. He can speak for himself. We'll just talk about the whole industry right now. I think for most companies, They just want to know the rules of the road and they get on with it. They're flexible enough, they'll navigate it. But when it's up and down and there's tons of volatility, and to Paul's point, the point he did make in response to that question is if it wasn't for tariffs, it'd be something else. That volatility is coming from all directions.
Well, we're also seeing it in the oil price. And right now, $4 a gallon of gasoline. At some point, does that mean consumers might defer buying a massive SUV, buying a massive truck that GM obviously is one of their main selling points?
You certainly don't see that in the GM numbers this morning. GM positive in the pre-market. Let's get you an update on news elsewhere this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. Following 10 straight days of military strikes between the US and Iran, the Associated Press reporting Iranian officials are now meeting with mediators in Pakistan. Reuters had reported a 10-day ceasefire had been suggested. Competition between the obesity drug makers ramping up. Novo Nordisk is suing competitor Eli Lilly, claiming Lilly's advertising for Zepbound and Mounjaro is misleading. Eli Lilly currently leads in US obesity drug sales. Tropical storm Bertha making her way towards the Gulf Coast. The National Hurricane Center forecasting as much as 8 inches of rain this week and warning of possible flash flooding from the Florida Panhandle to Texas. And that is your Bloomberg Brief, John.
Vonnie, thank you. More from Vonnie in about 30 minutes' time. Up next, the morning calls. Plus, we'll catch up with Abby Yoder of JP Morgan with the chip makers rebounding ahead of a key week of tech earnings. Live from New York City this morning. Good morning.
What we're going to probably find out at the end of this earnings season is that the free cash flow amongst the hyperscalers will cross that zero line, but the market's discounted that already. The market wants to see the confidence in the CapEx because if nothing else, you're going to stabilize the chip trade.
That was Julian Emanuel of Evercore weighing in on the chip trade and the tech sector this morning. The tech sector bouncing back this morning. The Nasdaq looks like this. The Nasdaq 100 higher by 1.3%. Big slide through last week, bouncing back this morning. On the S&P as well, following 3 days of losses, higher by 0.4. Big focus on the bond market. Notable that twos are back above 420 again. 420.64 closed above that level yesterday. For the first time since we had that softer than expected CPI read last Tuesday. That hasn't pulled yields lower on a sustainable basis anywhere on the curve. 10s are back at 460. 30s are north of 5.1%. In the commodity market, crude higher as well, elevated throughout the session so far. $90 on Brent. Just think about where we were a few weeks ago, threatening to break into the 60s on Brent, and here we are back in the 90s and higher by 1.5%.
That's because we've had 10 days of continuous strikes on the U.S. side, and then Tehran going back to U.S. Gulf allies and really targeting important civilian infrastructure like desalination plants as well. We got an update from the Kuwaiti authorities this morning. They're in the middle of a crossroads, and they can either take a 10-day ceasefire, potentially recalibrate. Both sides would have to agree to this, or things are going to get a lot worse. The Houthis could get involved. We have no shipping right now to the Strait of Hormuz, and the point you continuously make, it's coming out of time where we already have very low inventories because we've been drawing on them for the past few months.
Does this reintroduce just a bigger hawkish risk for the next couple of days for, say, the ECB on Thursday? For that matter, the Federal Reserve? A week away. We'll see. That's the price action. Let's get you some morning calls. First up, Wells Fargo raising its price target on Alphabet, expecting higher 27 CapEx to be passed through to customers. That stock this morning just about unchanged. Your second call from Morgan Stanley, downgrading Adobe to underweight, warning AI disruption clouds the path to revenue reacceleration. That name is down 5% today. And finally, Barclays cutting its price target on IBM, saying it's too early for it to show significant AI upside. That name is down by 0.9%. in the pre-market. Let's stick with the tech story. Chip makers rebounding following their worst week in more than a year as investors shift focus to big tech earnings. Abby Yoder of JP Morgan Private Bank writing, we disagree that the AI trade is ending. We know volatility can lead to opportunities, although we cannot pinpoint the exact bottom during pullbacks. We are buyers of conviction ideas. Abby joins us now for more. Abby, good morning. Good to see you.
Good morning. Good to see you.
You're getting at the question you're asked often. I'm going to ask it as well. Is it one trade? Is it ending? What's the pushback to those two questions?
I don't think it is one trade, right? Like, I think that's been the pushback right now from clients, and that's been their concern, right? Their number one concern is like, my entire portfolio is AI. I can't get anything outside of it. Even if I go to EM, it's AI, like it's very difficult to diversify. And I actually think when you look at the rotation that's happening within the market, right? The market's flat. You've got semis down in like a 20% correction, Korea north of 25%, but you've got the market flat, right? So you have other things working at the moment that are outside of this AI, trade, and I think that's what clients want.
The feel, though, Abby, is that they're still part of the same story. So yes, banks have started to pick up, but banks have benefited from all the AI capital raising, the IPOs, the spending elsewhere. If Lisa was on the programme, she'd also talk about the airlines, that some of the industry supporting airline revenue right now is coming from the tech trade. That's what kind of people are getting at right now. The economy's becoming a one-engine story for some ways in the minds of many as well.
I mean, I can understand that. It's definitely difficult to disentangle from an economic standpoint what is driving what, right? Like what's in the driver's seat. But for the most part, I mean, think about the commercial and industrial loan growth that you're seeing out of the banks. We've seen it accelerate from low, mid-single digit to almost double digit for some of these banks, north of double digit. We haven't seen that in like 3+ years, right? We've been in this manufacturing recession for the last couple of years, and you're starting to see that come out. And I think that definitely is partly related to the AI build out, right? Because that does, bring in the industrial complex. But I also think it has to do with the One Beautiful Bill Act and the immediate expensing of this CapEx that really does incentivize companies to invest and reshore and build. So I do think there's multiple components that are going into it.
When clients say to you they think that trade is ending, do you think potentially not ending? So I know you don't think that, but do you think it's softening?
I think it might change hands, right? I think we're like reverting it. It feels very much like 2025 again, when we had the DeepSeek moment, and then you had an everything rally, and then it just became much more discerning as it relates to, which names were going to win. And I do think it's becoming a little bit more consensus, at least, to lean a little bit more into the hyperscalers, because I think there really has been this belief, we come back to this narrative, like in the summer of last year, where it's like these companies have the benefit of scale, the benefit of all of this data. They have so many different underlying businesses that can benefit from a revenue and then also expense standpoint. I think we're really underestimating. Yes, they're tapping debt markets. They're changing the way that they're spending that money, but they're also going to change the way they're making money on these investments. And we have pretty high conviction in that.
How concerned are clients about what's coming out of China in some of these cheaper, low-cost models?
I mean, it's a major concern, right? But I think the other bigger concern would be if the government does take a stance where they say, you can't use these, but there's different use cases, right? There's a lot of different use cases for different models, right? And these open source ones are much more malleable, but they're not going to be like the most important. You're not going to use them for the most important task at work, right? You can use them for more menial things and use them, and they're more malleable. So I think it's just going to evolve, right? As this trade has continued to evolve over the last 3.5 years, it's just going to change. Like, companies are just going to use different models for different things, and that makes sense, right? Like, that actually is a smart business decision.
Year end 8,100 on the S&P.
Year ahead 8,200.
Year ahead
June 2027.
Okay.
Don't get ahead of yourself.
What's the path to that without chips participating?
Well, we think chips do participate.
Do they have to?
They don't have to. As you can see of what's happening with the market, I think you'd obviously have to see more heavy lifting in terms of the
Because the market right now feels like it's stalled. The index feels like it's stalled around 2% away from all-time highs.
Yeah. I mean, I guess, yes. Well, and to keep in mind, you've only recently seen the hyperscalers do well, too. So you can't have the chips and the hyperscalers not doing well, right? Like, from a market perspective, that just doesn't really work.
Can you imagine a world where both do well? That's been a struggle for a lot of people.
Yeah, I do. I think that if the hyperscalers continue to show that they're, garnering an ROI, a return on investment on their spend, and obviously the rate of acceleration in terms of how much they're spending, right? That growth will slow probably, right? Because this is just massive jumps year over year. But if they continue to spend, then that helps, the infrastructure. So I do think that there is a way, but it really requires, higher ROI and continued CapEx.
Can this happen if the Fed hikes interest rates?
It would make it more challenging, that's for sure. And mostly because when you think about what that would do to financial conditions, right? Because you do, again, have this changing of the guard in terms of this was all being funded from free cash flow before, and now, there's $190 billion of debt being issued in 1Q, right? So I do think that changes at the margin, given that you have that happening.
Are we close to breaching capital constraints? We had a conversation about an hour ago. And there was some concerns about how much money's being raised in both equity and debt. The Treasury's had a massive deficit for a long, long time. That might start to matter a little bit more. Anywhere near to the pushback you might expect from that kind of level of financing we're seeing so far?
I mean, you're not seeing it in the market really, right? Like if you were to get that signal from like the IG market where it really, I mean, obviously you're seeing spreads move to a certain extent, but like if you were to get that signal from the market, then obviously I think companies would think, okay, maybe this isn't the right way to do this. But when you have equity raises that are oversubscribed, I don't think that's the message that these companies are getting at the moment.
Final question. If Alphabet comes out tomorrow and raises CapEx, is that the kind of market right now that rewards that? Are we happy with that?
Only if they talk about how their revenue is accelerating alongside of that and in excess of what we saw in 1Q. Because we already did see clear signs of acceleration in 1Q as it relates to the revenue generation related to that CapEx. But again, we also had massive jumps in what was going to be expected spend in 1Q. So it's definitely going to depend case by case on if you raise CapEx, how are you monetizing it? And you've really got to show proof of that.
They certainly raised capital in Q2, a monster equity capital raise from Alphabet earlier in the year. Abby, it's good to see you. Thank you. Abby Yoder of JP Morgan Private Bank, constructive on this equity market. It's not just one trade and it's not ending.
Not one trade and it's not ending. And to Abby's point, she sees other parts of the market doing well. She still likes industrials and other parts of the market to potentially get to this bullish case of next year. But there are risks out there. Fed could hike interest rates. What happens if we get Goldman's $120 oil in the fourth quarter?
Let's hope we don't get 120 on crude. Let's
but
just
what
hope
if
we
the
don't go anywhere near
escalation
there.
just
I know.
continues?
And it does
only
continue.
going to go up, and we're drawing down inventories. It's going to get more challenging.
The problem persists. I just get this feeling of this market right now. No one wants to internalise that price of Brent. It's like it's not happened. It's still 70. Don't look there. It's not 90. It's still 70.
Well,
but it's 90.
tell that to consumers that are lining up for $4 a gallon.
I know. We're up again this morning by 1.6%. Coming up, we'll catch up with Rob Sockin of PGIM, calling for 3 Fed hikes this year. Plus, your Hira has your morning movers. 3M rising as the AI build-out helps fuel the company's turnaround plans. That stock is up by 6%. Equities firmer by 0.5 on the S&P, call it 0.4. At the moment on the Nasdaq, we're up by 1.2%. It's a better tone to this market. Chips started to perform. Last week they got hammered, down by 10%, entered so-called bear market territory, off by 20% plus from the recent high in June. Like
so
bear markets,
cold.
I know.
Every time you say it, it's funny.
I know. I struggle with it
I know you're
too.
rolling your eyes.
Well, when you're still up by 60, 70% on the year, it's not much for bear market, is it? But yesterday, things started to improve. The improvement follows through, some positive follow-through into Tuesday. On the Nasdaq, we're higher by 1.2. Switch to the board and get to the bond market. Yields still elevated, just can't get away from 420 on twos. Just can't get away. Yields up by a single basis point, 421. 10s, 460. 30s, around 5%, even with softer CPI. Softer PPI. This is where we're at, a week away from the Fed's 2-day meeting. It starts next Tuesday, concludes on Wednesday. And this is the reintroduction of hawkish risk coming from the energy market as well. WTI and Brent up again today by close to 2% now, closing in on 91 on Brent crude, 85 on WTI.
This is for sure going to be a problem for the hawks and the Federal Reserve next week. And if Lisa was here, she would say it's going to be a problem this week for the ECB, especially given how vulnerable Europe is when it comes to higher energy prices. But look, you do have mediators right now in Pakistan having this meeting with the Iranians. There's a choice to be made. Do they want a 10-day ceasefire? Or do things get a lot more hostile? And things can get a lot more hostile. And already they are hostile. The United States has lost service members. You see the Iranians coming back with targets in Jordan, desalination plants in Kuwait. Things are very challenging right now, and they can get even more volatile.
This is the frustration for both policymakers and investors. I can imagine a scenario where 2 weeks from now we're at 70. I can also imagine a scenario where 2 weeks from now we're back at 110. And if you're a policymaker who needs to set interest rates, that's not much good to you right now. If you look at the broader backdrop, the bigger problem is this is only one piece of the broader inflation puzzle right now. The price pressure is coming from all directions. We spoke to GM about it 30 minutes ago. If it wasn't for what's happening with crude, it's something happening elsewhere. The pressure keeps building.
And that is on display this morning. We started the show talking about what's going on with TSMC, raising prices going to 2027, according to a report from Nikkei. What about the fact that we woke up this morning, yesterday, the president reintroduced fresh tariffs on Canada? Now, the market's shrugging that off because they've seen this story before. But the fact of the matter is we still have higher tariff levels and USMCA is still getting negotiated. There's a lot of pockets of risk right now around the world.
Investors right now, you just want to sort of bury the tariff story. Forget about that. Doesn't exist last year. Don't even want to talk about it.
I think the second I started talking, people just hit mute.
Like totally,
mute,
just like
mute.
get rid of the tariff stuff. Energy, I'm not going to look at 90. I'm just going to pretend it's 70 still. That's the feel right now. Just focus on the earnings, and the earnings have been absolutely fantastic. 1 hour away from the opening bell. Let's talk about some of those stories. Your morning movers, Yahara has more. Hey, Yahara.
Hi, John. We start with some deal news. Sending shares of Utz Brands soaring 88% in the pre-market after the company agreed to be acquired by Germany's Intersnack in a $14.25 a share cash deal, taking the company private and giving this German company a bigger foothold here in the U.S. So investors sending the stock closer to the takeover price as investors bet this deal will close at the end of this year. And talking about other chips, we are seeing a rebound in the chip and memory stocks this morning with SanDisk and Micron all higher, as you said. The Philadelphia Semiconductor Index snapping a 3-day losing streak yesterday, and the recovery continues again today. And the thinking is, among some, is that the recent pullback has provided a good entry point. We also heard from TSMC saying that it is planning to raise its chip making prices, so that also boding well for the sector. And we end on shares of 3M. They are rising 6% after it posted a beat on both profit and it posted a raise. And that's because it's one of those industrial companies benefiting from the AI build out. The CEO, Bill Brown, is pushing further into data centers. They just announced a deal with Microsoft, and that strategy, along with the broader turnaround push, is starting to show up in the results. John.
Yahara, thank you. That stock is up by more than 6%. One to watch into the cash open, about an hour away. Let's turn to the economy. Yields remaining stubbornly high as inflationary headlines add up this morning. Brent crude back at 90. The president putting tariffs back on the agenda, and a report that Taiwan Semi is planning to hike prices for chip makers. Ira Jersey of Bloomberg Intelligence joins us now for more. Ira, welcome to the program. What is it about this bond market right now? We can't get away from 420 on 2s, 560 on 10s, 5% on 30s.
I think that's right, John. And I think one of the biggest things is the uncertainty about the inflation picture. So even though June we had certainly better data, when you have oil prices going up, that feeds through to a lot of other markets and industries, even in the core sector. So you think about things like transportation costs, for example. All of those things are going to lead the market, I think, to suspect that central banks globally are going to hike interest rates. Now, will the Fed actually do that? I'm not as convinced of that. And in fact, I suspect that they'll wait until they have all of these task forces out of the way before they think about hiking. So I do think that if they do hike, it's not until next year. But the ECB this week, sure, they're going to probably signal another hike. In fact, my colleagues in Europe think that that September hike is very much in the cards for them because they have a single mandate, whereas in the U.S., we do look at that 57,000 jobs and say, that's not great. So, maybe we have to worry about both sides of the Fed's mandate.
Beth Hammack disagrees, Ira. Do you think she's got company at the Federal Reserve?
Well, I do think that there are a few members who are going to be hawkish, right? I mean, the Dallas Fed is always hawkish, right? So Lori Logan might think that the Fed's going to hike. And when you look at the dot plot from June, there certainly are some members who believe that they're going to need to hike interest rates later this year. But it is a very mixed bag. And I do suspect that Kevin Warsh and others who are on the, maybe not the more dovish side, but the more let's stay on hold, let's see more data side, will convince the rest of the committee not to do anything until, at earliest December of this year. But again, I do think that they'll wait until they have all of these task forces out of the way before they think about doing any move. The big thing, John, for the market, I think, is the market is currently pricing about 2.5 interest rate hikes and then a cut immediately after that. Yeah. I think one of those two things is wrong. They're probably not going to cut right away after they hike, or they're not going to hike as significantly as the market's price.
So, Aaron, let's deal with the near term. Let's get the sequencing straight. Let's deal with what we're dealing with right now in the next couple of weeks. The hawkish risk, so to speak, is relative to what is in the price right now. And if we can bring up the bond market again, you and I can just look at 2s right now. The 2-year has been comfortably above the policy rate of the Federal Reserve for the last several months. Ira, is that enough of a cushion to sit here and say, actually, the bigger risk next week might be dovish risk and not hawkish risk?
I think it is. I think those people who might be short the front end of the market might get stopped out, just because if Kevin Warsh does say, hey, there was a turn in the data in June, we have to wait and see if this trend is going to develop or if we're going to turn significantly. I just think in our view, and we put out our preview this morning, I do suspect that they'll be a little bit less hawkish. I'm not going to say that they're going to be dovish. They're not going to be dovish, but a little bit more tempered than they were in June. Basically saying, let's take a wait and see attitude for now, but with a hawkish bias. So I do suspect that we'll keep on pricing in for interest rate hikes, but again, maybe at December at the earliest, probably next year.
Ira, appreciate it. It's good to see you, buddy. Thank you. Ira Jersey there of Bloomberg Intelligence. That's the market question for next week. The bar's pretty high. We've baked in some hikes for the year ahead. How difficult will it be to out-hawk this market? Rob Sockin of PGIM anticipating 3 hikes this year from the Fed. He writes this: the US economy continues to power along with above-trend growth, above-target inflation, and now a warming labour market. And these factors suggest that Fed policy will become more hawkish. Rob joins us now for more. Rob, good morning.
Morning.
You heard what Ira had to say about things. Ira Jersey thinks maybe we'll disappoint some of these hawkish expectations. That's his view from Bloomberg Intelligence. Why do you take the other side of the debate this morning?
I would point to 2 things. One, when we look at the drivers of inflation, above trend GDP growth, what we think is a warming labor market that'll put upside pressure on wage growth later this year, and a range of supply side challenges that aren't just energy, but in trade, in tech, in labor, they all suggest upside risk to inflation pressures. That would be my first point. And so we think inflation is not going to move back down to the Fed's target without additional policy tightening. The second is, I think hawkishness at the Fed is reaching a type of critical mass. I mean, it's not just Chairman Warsh. It's not just the most hawkish members of the committee, like Lori Logan or Beth Hammack. Really, you're hearing everyone else speak more and more hawkishly. And so I think the bar for hikes is relatively low. I don't think they'll hike at this meeting, but I think it'll just take a firming back up of inflation in coming months for them to start raising rates.
So when's the first hike? Because we also have a midterm election this year.
Yeah, and that's a concern in the background. We think the first hike is going to be in September, and you'll have a sequence of 3 rate hikes in the back part of this year. The midterms are obviously a concern. The Fed would like to avoid seeming political in any way it can. But we think at the end of the day, it's going to come ultimately down to the economics of it. And you're hearing that from Fed officials. Before the soft CPI print that we just got, Governor Waller effectively said, one more hot print and we're going to have to hike rates. And I think that logic is going to come back into play in coming months. So ideally, there wouldn't be a midterm election around the corner they'd have to hike into, but I think the economics are going to overrule that.
But where we're seeing inflation right now, these pressures are coming from the oil market, potentially tariffs, higher chip costs. Can hikes actually solve the problem?
Well, I think that the idea would be you hike rates, tighten policy, take some heat out of the economy, which is running above trend. It won't solve some of these supply side issues. Maybe it'll cool demand in certain sectors that will ease some of those pressures. In an area like AI, which seems mostly rate insensitive, but maybe it cools some of those pressures where it's strong demand and strong supply. But ultimately, I think it's about taking some of the heat out of the economy so you get less pressure in those non-shelter services prices. That's the Fed's big problem. That's the majority of PCE, and that is running 3.9% year over year. We don't think it's going to cool down without some additional policy.
You think we need tighter financial conditions?
Tighter financial conditions, exactly. And I think, any set of reasons that you outline here, I think they're all upside risk to inflation. Financial conditions are loose. The above trend GDP growth, which we think is, despite the higher oil prices, is going to firm in the back half of this year, and the tightening labor market. They all add up to you need to do something. And we think 3 rate hikes is the way to start.
What tells you there is genuine intent here to do something and that this is not just a communication exercise?
Yeah, that's the real challenge. Talk is cheap, as they say, and maybe it's just talking tough, and there's a lot of logic to go behind. Maybe the Fed just needs to seem like they're committed here to price stability and then let some of these factors play out. But I think, if we go back to some of the communication we're seeing, I think the speech that aligns most with our thinking came from Lori Logan last week, where she said, inflation is going to ease, but with all of these risks, you can't be sure you're going to move down to 2.5%, to 2%. You're going to move down more to like 2.5%. And the number one thing that I think Chairman Warsh has said in his tenure so far is he wants to get inflation back down to 2.0%, not in the vicinity of target, but back down to target. And so that's why I think it's not just talk, because I think with these dynamics in the background, you can't be sure that you're going to move back down to that goal of 2.0%.
Out of interest, personal question. Are we kidding this news conference? Does it stick around?
Well, you know, you have these task forces in the background. I think most of those are 2027 story, but we've seen changes to communication. I think the press conference is going to stick. I think that's going to be hard to remove. I think the dots may go away eventually, but some type of forecast apparatus will remain. A lot remains to be seen. Certainly in June, it was a very different press conference than we saw from prior Fed chairs. I think that'll stick, but it will be changing over time and very different than what we're used to.
Rob, it's good to see you.
Great to see you.
Rob Sockin of PGIM looking for 3 hikes from this Federal Reserve.
As he's talking about the task force in the background, I was thinking maybe if Fed Chair Kevin Warsh doesn't want to greet the press, he'll have the head of the communications task force, or one of the heads, Mervyn King, come out and talk to the press.
I'm sure they'll do a news conference.
Can you imagine? You just outsource it?
Several news conferences coming up as those task forces wrap up. Rob, it's good to see you. Thank you, sir. Equity futures on the S&P just about positive so far this morning. On the S&P 500, up by 1/3%, with an update on news worldwide with your Bloomberg brief. Here's more from Vonnie. Hey, Vonnie.
Hey, John. Thank you. The Trump administration announcing new 50% tariffs on a range of Canadian goods set to take effect in 30 days. The White House is citing what it describes as unfair Canadian treatment of imports of U.S. dairy, autos and alcohol. JP Morgan CEO Jamie Dimon reiterating his criticism of the UK's bank tax surcharge. Dimon saying the tax hikes could drive capital away as they lead to an uncompetitive tax system. He says UK politicians should be worried about the number of companies that have delisted from London in recent years. Goldman Sachs says oil could trade above $120 a barrel by the fourth quarter if disruptions in the Strait of Hormuz continue. Currently, Goldman sees Brent at $80 a barrel in Q4 and $75 a barrel next year if tensions in the Middle East de-escalate. And that is your Bloomberg Brief. John.
It's a big if things stand. As things stand this morning, that's for sure. Hey, Vonnie, thank you. Thanks for this morning. Up next, we'll set you up for the day ahead and the week ahead as well. We'll touch base with Darryl Cronk of Wells Fargo, preparing for 2 big weeks of earnings reports.
If we get into the sell on the news on price perfection, there is going to be sector rotation. You got the hyperscalers. They're spending like drunken sailors, and they will until they have to because they can pass on costs. Where we run into a problem is that the end customer just can't take it anymore.
That's the big debate. How close are we to that price pressure building further and further downstream to the point where the customer starts pushing back? That was Ted Mortonson there of Baird on the tech sector. Here's the price action. Tech doing better again, up 1.4% on the Nasdaq, on the S&P higher by 0.4. As we count you down to the open and bow, let's call it 41 minutes away. This is the trading diary for the next 24 hours and the next week. At 5 p.m. Eastern Time, we'll hear from the President. He's meeting with House GOP members in the Oval Office. Look out for comments from that. Looking ahead to tomorrow, Alphabet, Tesla, IBM all reporting earnings. On Thursday, results from Intel, American Airlines, the ECB with a rate decision. The ECB in focus. How much hawkish risk has been reintroduced from the oil market for that meeting, which kicks off later this week and ends on Thursday. We'll get some jobless claims too and some PMIs into the weekend. They'll drop on Friday morning. Investors awaiting those key results from the data and the earnings. Darryl Cronk of Wells Fargo maintaining a year-end S&P target of 7,900, writing, we continue to favour stocks over bonds and see diverse opportunities amid a steeper yield curve. Darryl joins us now for more. Darryl, welcome. Let's talk about the stock piece of this first. Why stocks over bonds?
Well, I think Obviously, the earnings growth continues to drive. Multiples have actually cheapened in 2026, so PEs have come down, not gone up like they have for multiple years. And as interest rates continue to grind higher, right, across the curve, it just erodes bond returns. I mean, your prior guest was talking about 3 Fed rate hikes. If that's the case, John, the 2-year Treasury is mispriced here, even at 420, right? We walked into this year, the 2-year was a 347. Today it's 420. It's up almost 75 basis points, throughout 2026. The long side continues to leak higher. Just bond returns are just tough here, notwithstanding decent income.
Well, Darryl, let me get into that. Let's say he's right. Don't know if he is, of course,
Yeah.
but let's say he's right. You get 3 and we're mispriced at 420. You need to go higher. I don't know what 2. Let's say we go to 450 on 2s. Let me just throw out a number.
Yeah.
Where's the yield curve in that world? A 10's coming along for the ride. How does the short-term move, the move at the short end of the curve, inform your view, your outlook for the longer end of the curve?
Yeah, I mean, think about it this way. We walked into this year basically with the bond market pricing in 2 rate cuts for all of 2026. We quickly walked that back as inflation started to resurge. Now we're pricing in 1 hike. If you got to price in, let's say, 2 more, right, you're at least at 450 on the 2-year. To your point on the curve steepening, today 2s to 10s are like 36 basis points. I think the 10 and 30-year have to come along for the ride, because what you have to think about there, John, is what makes up the long side of the curve. And the long side of the curve is a risk premium, a risk-free rate, plus a term premium, plus an inflation premium, plus a growth premium. Growth is going nowhere in that environment, right? Term premium and inflation premium would have to go higher by some amount. So I do think you'd see long-term rates, and actually it's in our year-end 2026 numbers, to be higher than they are today.
This is one of your favourite calls in the equity market, and the bond market shapes that view. It's the banks. Darryl, it started to happen.
Yeah.
7 weeks of gains for the banks on the S&P 500. Fantastic earnings. The trade's working. Why do you think it will continue to work?
Well, everything's lining up for the banks, right? I mean, you've got the M&A activity, which posted the biggest quarter in second quarter that we've seen in the history of the markets, right? The history of the century, right? Almost 1.6 trillion of M&A, right? Issuance is off the charts, as you've talked about, on both the debt and the equity side. Loan growth is happening. Margins are expanding. So the environment is incredibly good. And to your point, in the last 30 days, the financials have outperformed the broad S&P index by almost 600 basis points. I think the key here, John, that people miss, like the one point they miss here, is what's happening to volatility on the surface. If I take the VIX at a 16, 17 times, which would be kind of nothing to be concerned about at the broad index level. If I take the VIX EQ, look up the VIX EQ, which is the constituent volatility, implied volatility, it's setting basically new multi-year highs today, right? Which tells you that the underlying volatility under the surface is churning much more than what people realize, which tells you breadth is deteriorating, correlations are falling, and actually dispersion is widening in that environment. People are not talking about that enough.
Beneath the surface, Darryl, it's been pretty vicious. Want to build tech into the conversation as well. Let's fold that in too. You mentioned these 2 weeks of massive earnings. Let's bring up the board again. Check out this graphic. The amount of market cap that reports in the next week or so. Tesla and Alphabet in the next 24 hours. Next Wednesday, we'll hear from Microsoft and Meta. You'll hear from Apple and Amazon in the following 24 hours next week too. Darryl, how much risk is there? Because when we got the bank earnings, they were great. Took a while, though, that morning for the stocks to start moving. In the end, they did. It was touch and go for a little bit, but the rally picked up. Are you as hopeful for these tech names? Is the bar just a little bit higher when it comes to what's priced into these stocks?
I think it is a little bit higher. Now, the good news is, like on the semis and some of the hyperscalers, we've taken the froth off, right? You noted earlier, they were, the Philadelphia Semiconductor Index was down 10% last week, is now down 20% in bear market territory. Still up 68% year to date, still up 108% year over year. But the bar is exceedingly high. I do think the CEOs and CFOs of those hyperscalers and semis and tech broadly are going to come in and say, not only are we willing to reaffirm the CapEx, but we're willing to spend the money. The big backlog is in the construction, in the engineering, in the energy pieces. So the real question will become, and the markets will have to reconcile, can the build of AI get done as fast as people want and expect, or as fast as the market expects? I think that's where the choke point ends up becoming. And it's not a willingness to spend. It's not even an ability to spend, because the free cash flow is there. If I look at the hyperscalers, their backlog is over 100% of sales right now. Like the demand is there off the charts. I mean, it's undeniable.
It's crazy, the amount of money flying around at the moment. Darryl, thank you. Appreciate your view on things. Darryl Cronk there of Wells Fargo on why he likes equities over bonds, why bonds might be mispriced for some rate hikes we might see, and this equity story powered by fantastic earnings. Let's bring up that graphic again. The earnings you're going to see in the next week from the tech sector, the market cap here that we're talking about is just phenomenal. Tesla, Alphabet, next week, Microsoft and Meta on the Wednesday, just to clarify, Apple, Amazon, the day after on the Thursday. That is a tremendous lineup of companies over the next 10 days.
And everyone's going to want to read on how AI spending is shaping the tech industry and this entire trade. All of these individually are going to be massive, potentially catalysts for the entire financial market. But when you hear from Darryl talking about the money is there, how quickly can they build this out? And I look to some of the risks right now in the build out. Energy prices are going up.
Yep.
It's going to cost a lot more. Political risk is going up. Can you even build, say, a data center? In some states, you can't.
Crude at 90. Let's not talk about that. It's not happening.
It is happening.
Stocks are doing better, up by 0.4% on the S&P tomorrow. Max Kettner, HSBC, Angelo Zino of CFRA, Mira Pandit of JP Morgan, and the AT&T CEO, John Stankey.